We're very far away from what these job market reports need to start to look like.
We keep printing lots of jobs. People have got jobs, they got money, they go out and they spend.
We just think that this market remains fragile and vulnerable, and we're looking for another 5% or so pullback from here.
The U.S. is settling down while the world is holding up a bit.
12 months from now, we think the Fed is aggressively cutting rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Getting your week started with the equity market positive 0.1% on the S&P 500. And Tom, looking ahead to a survey we've waited a long time for. The Senior Loan Officer Opinion Survey coming out a little bit later on this afternoon. A lot of people waiting for that one to drop.
I agree, and it's after the percentage move we saw in the banks, which I thought was a non-story on Friday. It's going to be interesting to see how the banks reset. I look at PacWest debt this morning. It hasn't reset 100 down to 40 price. So that survey will be good. But there's another survey May 10th. I believe that's Wednesday, and it's CPI Wednesday.
Then it's PPI a day after. Looking ahead to those data points a little bit later on this morning. Looking at PacWest in the pre-market. Remember, PacWest last Monday was a $10 name. At the pre-market right now, it's back up to $8. So slowly, Lisa, crawling its way back up.
Yeah, although why, right? Because they cut their dividend? Maybe. Because people are thinking that they overreacted? Maybe. When I actually read the analyst reports, there are very few people saying, let's try to catch a falling knife. There is a question of whether there's a larger either policy response or something that has to happen to bring people back to these banks as investors, let alone as depositors. And this goes beyond just a faith in getting your money back. This goes to a question about the existential profitability of some of these firms.
Before we move on from Friday too quickly, should we talk about payrolls and the move we saw in the equity market? Data good, equity market up. Good news, good news?
Well, so this is what I don't really understand, right? Are we now at the point where people are putting aside the idea of rate hikes completely, saying that the Fed is going to have to cut rates? We haven't yet seen the potential consequences of tighter credit, and yet hotter inflation than expected isn't necessarily a problem anymore. I mean, when did that change? I'm not exactly sure what that means.
Brett Ryan, Deutsche Bank, we've lost that hiking feeling. Remember that song, Tom?
Yeah.
Great song. We've lost that hiking feeling. We can now enjoy the benefits of good data without the threats
of you to bring that up.
Of higher interest rates.
Yeah, it's a stew. Last week, we're all exhausted by last week. It didn't work out this weekend. We didn't recover. We dive right in here on Monday. And to me, so much of this, and to our good guests we're going to get to here in a moment, it's about supports and resistances, whichever index or series you're looking at. And we're collared in here trying to break out, and it just ain't happening.
Great song, Tom.
Thanks for wrecking it for me, by the way.
Why?
Because now I'm going to be singing, "You've lost that hiking feeling." And I'm just going to come like such a
listen to
nerd.
that
It's going to be ridiculous.
Best scene in Top Gun.
Oh, my God. Okay, I know, but it's just
awesome.
It's.
We should get Tom Cruise on the show. Get him to do his rendition of "We've Lost That Hiking
He did
Feeling."
a thing for the coronation, I think, from a jet.
Did he?
My
I didn't see
coronation.
that.
Yeah,
Surveillance Royal contributor noted that.
Was that it? You are our royal contributor.
Yeah, well, Mr. Cruz, and somehow Christian.
This is the coverage right now.
Christian Horner was there or something. I don't know how he got to the coronation and got back to Miami, but you know, I watched every minute.
Good to know. That's your coverage. Your equity market looks like this on the S&P 500. Equity futures positive 0.1%. Just a whip through the price action for you in the bond market. Yields higher by a couple of basis points. Your 10-year 345.97. Lisa joked about the euro against the dollar for the whole of last week.
Yes, I did.
Have a look at what euro dollar did on the week last week. Dead flat, like literally unchanged.
Well, I'm shocked.
0, 0, 0, nothingness.
This is the shock face that I have. But this is the lack of understanding of which way you're going to go. And yesterday, I will note that even when we get economic upside surprises, that has not been good for the dollar. So go figure. Here's what we're looking at today, but for also the rest of the week, just to set up a sequence of events. Today, we do get the Fed's latest Senior Loan Officer Opinion Survey. We've been waiting, and it comes out at 2 p.m. The amazing thing is everyone's going to explain why it doesn't matter when it comes out. We are seeing a pop in some of the regional banking shares, a sort of recoveries early this morning. They still are highly beaten down. People are going to talk about how it's lagging data and it doesn't accurately reflect the ongoing credit tightening. Tuesday, tomorrow, U.S. President Joe Biden is meeting with congressional leadership, including Mitch McConnell, as well as Kevin McCarthy. We're not talking about the debt ceiling, and yet Janet Yellen was saying June 1st is when we run out of money. So can we get some agreement there? On Wednesday, we get CPI followed by PPI on Thursday. Are we going to start worrying about inflation again? I mean, this is really the issue. Can we start worrying about rate hikes again, or is that off the table because people are convinced that the tightening in credit conditions will do the work for the Fed?
We've got to talk about the latest polls as well. AMH next hour, Biden in the latest ABC Washington Post poll. Not looking good. With us around the table, Michael Purvis, founder, CEO at Tollback and Capital Advisors. Michael, good morning to you, sir.
Good morning.
Is good news good news?
Well, it was on Friday, but look, I think one of the issues that the market really has to confront with is not earnings. Earnings have been actually really pretty decent through this quarter. And in fact, if you look at the 3-month change in forward bottoms-up estimates, they're positive now. For the NDX, for the SPX. The SPX equal weight is about to be positive, it looks like, right? Most of the companies have come in. So the issue, and by the way, I'm at 3650 for my year-end target from last December, which admittedly is a little bit low given where we are right now. But the real issue is valuation. And the valuation argument, I think, comes down to, can you really have 18 to 18 and a half times forward earnings with an earnings profile that's not bad, but it's not really robust either, right? And particularly if interest rates are going to, I think, have a hard time really contracting. Look, if you tell me that the 10-year is going to be at 2.5% at the end of the year, then maybe you can sort of back into this, right? But I think what in the math I do, I sort of get to like a normalized multiple for a sort of higher floor in inflation, higher floor in interest rates than what we had been used to during COVID. Is more like a 16 to 17 times multiple than an 18 to 19 times multiple.
And your research note describe that we can't get through resistance at 4,200. A lot of people are on that page.
Yeah,
describe why we're not going to 4,300.
Well, look, 3,800 to 4,200 has been a pretty, for me, and I think some other folks, a really defining range here. Getting through, it's sort of 4,180, 4,200 it's just a very important technical level. You can cut that a few different ways here. We've sort of touched up against it. But if you look at sort of, momentum signals, things like MACD, Tom, those are, on the short-term daily basis, those are kind of rolling over here. So then you step back and say, okay, well, we're kind of at terminal, right? We're through this earnings cycle. What great news are we going to have to really power through this key resistance level and open up that real estate to 4,300 and 4,400 there? And implicitly in that, you're sort of saying the market is self-sustaining at a significantly higher valuation here, maybe 18.5 to 19 times. And I think that means that things have to be really, really good here. Let's not forget, there's been a lot of positioning here. A lot of people have been on the sidelines for some time. There is some, sort of FOMO that's happening here there, but FOMO is ultimately not a long-term investment case.
So going forward, though, this seems like it's been an exhausting year. It seems like it's going to continue to be an exhausting year. Sorry, it's just the truth.
It's early May.
I know, but it feels like it's been
Tuesday.
a really long year.
It's Monday, early May. Bramo's done.
Pretty much. I retire. So listen, this is the curious thing. It's been an exhausting kind of trading range with whipsawed projections and people basically being forced to face a huge humility in all of their convictions being upended early. For you, do you have conviction right now that we are going to see declines into year end, or do you think that this push-pull of whether you get tech as the leadership, whether you get some sort of cutting of the rates, all of these things will just keep us in this exhausting range for the whole year?
I mean, look, I think there's been this tension within the markets really since last summer of people sort of speculating that there's going to be this big economic contraction that's going to clear the air and allow us to sort of come in and sort of see the light at the end of that tunnel there, right? But the problem is that we don't get that. That foot doesn't fall, right? That second foot does not fall. We're not seeing it in earnings. We're not seeing it in the economy. We saw a strong jobs number. We saw reasonably decent ISMs there, and so I think that tension is going to keep Powell on the front foot much more. Right now, we have 5 cuts priced into Fed fund futures over the next 12 months. That's a lot. right? Now, probably the dots will get tweaked a bit down on the June FOMC, which is now just around the corner. But I think you're going to, there's going to be this enduring tension where pretty decent news means earnings don't collapse, but multiples probably need to contract if we can't see a path to 2% inflation. And I think that's the sticking point. So to my mind, the second half of the year is more about people adjusting to this weird reality and probably PEs contracting and 6-month, 12-month T-bills offering very healthy alternatives to buying the S&P 500 at 18 or whatever times earnings.
Something's got to give. I feel like I've been saying that repeatedly for like 5 months.
That's the reason why it's getting
something's got to give.
And to Lisa's good point, I mean, people, whether you're negative or positive, you want movement, and we're sort of just all exhausted by the churn as well. Do you know we have a surveillance Roiled contributor in Cambridge?
Who is that?
Elarian.
I know, Mohammed.
On top of it. Elarian emails in and briefs us because I'm as clueless as anybody.
We're paying him for this contribution.
This is an Elarian add-on. Tom Cruise at the concert, like with Katy Perry, Lionel Rich, he did a cameo thing. He's 60, and he chooses his wingman, the new king.
Well, he's doing his own stunts as
I
well.
had no idea he was 60. I'm clueless.
It works out so hard, Tom.
Yeah,
that's
like
what
you.
it's all about. It's not plastic surgery at all.
No, I think he works very hard. It's very hard work.
He's cut and chiseled like Michael Purvis.
Hey, Michael, thank you.
Hardly.
Michael Purvis of Tallback & Capital Advisors. Mike Wilson this morning, Morgan Stanley. Let's pick up on that note a little bit earlier.
Please.
The equity market continues to expect the best of both worlds. He goes on to say rate cuts and durable growth. We view the likelihood of both of these outcomes playing out in concert this year as low. Equities are priced for an optimistic and lower probability outcome. Bramo, Mike Wilson, earlier this morning.
My favorite imagination every Sunday night when I read these notes is how he tries to spin it in a new way, because it's basically repeating the same message. Guys, you're wrong. Guys, you're overly optimistic every single week. And yet this is the exhaustion. It's like, at what point does the data actually come out, confirm it, and then get the market reaction everyone's looking for?
Only 10 minutes into the week. Exhausted.
Sorry,
I've used that word
bring
about
it up
5 times.
Okay, all right,
this
that's
morning.
my fault.
Let's get it together. Lebo, David Leibovitz of JP Morgan Asset Management in the next hour. Looking forward to that conversation. Your equity market on the S&P 500 positive 0.1%. Live from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there are no good options for solving the debt limit stalemate other than Congress lifting the cap. Yellen told ABC that the White House resorting to the 14th Amendment would provoke a constitutional crisis. President Biden discusses the matter with congressional leaders on Tuesday. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. Now, the 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest that was jammed with ammunition. Japanese Prime Minister Fumio Kishida has finished a landmark visit to South Korea. He met with President Yoon Suk-yeol and pledged to seek cooperation on high-tech goods. Kishida said the trip helped, quote, deepen the relationship of trust. The visit marked the first formal summit in Seoul between the neighbors in a dozen years. It's a holiday in the UK following the weekend coronation of King Charles III. The crowning ended Charles's 7-decade wait for the throne, and it marked a turning point for the UK and the monarchy as it tries to adapt to the current era of technological and social change. The king told a packed Westminster Abbey that he had come, quote, not to be served, but to serve. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There is no way to protect our financial system and our economy other than Congress doing its job and raising the debt ceiling and enabling us to pay our bills. And we should not get to the point where we need to consider whether the president can go on issuing debt. This would be a constitutional crisis.
Janet Yellen over the weekend, the U.S. Treasury Secretary speaking on ABC with a simple message. It's Congress's job to get it done. Live from New York City, welcome to the program on TV and radio. This is Bloomberg Surveillance, and here is your price action on the equity market. Friday session, a nice lift, trimming some of the losses on the week, up on the day, down over the previous 4 days. On the S&P 500 this morning, we're positive 0.1%. Equity futures grinding just slightly higher. Yields higher by a couple of basis points on a 10-year, 345.78. And in the FX market, positive by 0.2%. The euro against the dollar, Tom, 110.43.
Let's move on right now as we get reset here for the week. And what a week it's going to be with inflation. It's Wednesday, John, right?
Then on to PPI the day after that.
Yeah, huge deal. I think it's been underplayed in all the exhaustion over the banks. But nevertheless, here we are with the banks. We need to begin our coverage this Monday with Erica Najarian, equity research analyst, large cap banks and consumer finance at UBS. It's off your remit, Erica, but with all of what the Union Bank of Switzerland has studied in the last 2 weeks, is it all clear on these troubled banks that bounced on Friday?
Tom, there's a big difference between fundamentals and market sentiment. So fundamentally, we did see the deposit data that came out on Friday afternoon. And what the fundamentals will tell you is that there's nothing really happening to the industry that is outside the norm of what happens cyclically. In other words, you do have deposit declines when the Fed is tightening monetary policy. And when you saw the reports that came out from the stocks that have been getting hit the most, PacWest and Western Alliance, when they released information last week, there's nothing unusual happening on the deposit flow side there as well. That being said, right, the market sentiment is so that the most bearish investors are sort of looking for that next zero, if you will, right? They're thinking that this is a multi-stage crisis like the global financial crisis.
Are you going to learn more with the Senior Loan Officer Survey? When is it, John? 5 p.m. this afternoon?
2 p.m.
2 p.m. this afternoon during the surveillance nap. Erica, are you going to learn more off of the Senior Loan Officer Survey?
No, and that's because I think that loan growth is going to tighten anyway. So if you look at the Senior Loan Officer Survey from several months ago, and you pair that with company commentary during the earnings calls, right? It's pretty clear that the largest banks and the smallest banks are tightening their belt, whether or not it's rising funding costs or, it's essentially not wanting to be the last lender, heading into a recession. So my guess is that the results of the Senior Loan Officer Survey is not going to surprise me, and that it's going to say that credit supply is tightening.
Erica, are you concerned just generally about how there has been a lack of a rebound in the KBW banking index? Yes, we're looking at a rebound in some of the shares, most beaten up on a percentage basis, but still well below where they have been. Does this sort of speak to you about the lack of faith and a need for some sort of washout before investors come back?
Not necessarily. So let's separate the liquidity crisis with the cyclical investment case. So we're of the mindset that the acute liquidity crisis should be behind us, right? But that being said, let's think about what's facing banks. I like to call it the 3 R's. There's rates and how it impacts funding costs near term. There's the probability of recession, which tightens credit supply and increases credit costs as banks anticipate a tougher time from a macro perspective. And there's regulatory in terms of the structural changes that could come out that would tighten regulation for the large regional banks. So if you put that all together, I can understand why the long-only investor community is hesitant to step in. That being said, I think the price action from last week actually spurred a lot of long-only calls. I'm not sure if they're necessarily buying right now, but it certainly feels like they're sharpening their pencils, thinking that, all of those things that I just mentioned are now discounted into the share prices.
That said, Erica, there's a bigger question around the business model of some of these regional banks. Torsten Slok of Apollo put out a number of charts over the weekend talking about how banks with less than $250 billion in assets, the smaller banks, account for 50% of all commercial and industrial loans and about 70% of all commercial real estate loans outstanding. Is this a proper business model at a time when deposits could be withdrawn as quickly as they have been, and when the profitability prospect really changes with rates going up as quickly as they have?
First of all, that's not a proper statistic. So if you think about the entire world of business lending, banks are essentially 16% of all business lending. So I'm including the debt markets, I'm including private credit. So banks, including JP Morgan and Bank of America, plus those banks that you mentioned, are 16% of the credit supply to commercial industrial loans. So keep that in mind. And the other part on the commercial real estate, it's something like 50%. But if you think about it, that is the business model that serves the small and medium-sized enterprises in the United States. Because at the end of the day, if you're a shop around the corner or you're, a widget factory, say in North Carolina, sometimes your community bank or your regional bank is closest to your need. You could have a 3-story, office building somewhere in Long Island, and again, your local regional bank may be the best that fulfills that need.
But Erica, you raise a really interesting point. Are you saying that people in the market are overstating and incorrectly representing the role of small banks in the U.S. economy, and they actually have a much smaller footprint and frankly are much less necessary than a lot of people put out there?
They're not much less necessary at all, right? Because at the end of the day, that market share I gave you is based on dollars, right? And so that big building across the street behind me is certainly going to be a bigger dollar, right? And that's why that share is, as I stated. But just because those small businesses are smaller from a dollar perspective doesn't mean that they're smaller in terms of the impact of the U.S. economy and the impact of employment. So yes, I think that the smaller banks in the United States that lend to local real estate and local businesses are a key part of the U.S. economy.
Erica, thank you. We have to leave it there. Just wonderful as always. Erica Najarian there of UBS on the financials right now. Fantastic job from the team here at Bloomberg over the weekend. The S&P Financials Index sitting right on top, Tom, of the 2007 peak. That would make it 16 years of just nothing. No returns whatsoever from that index.
And it's so important, that phrase, just nothing, because that's the emotion that's out there for certain subsets of banking. We lump them all in, even Keith Briette, the BKX index is the same thing of different kinds of banks. Which kind of bank does Warren Buffett own? He made clear this weekend he has a mystery about how you own the small banks.
He was pretty clear-cut about it. He basically said that it was mismanagement from the very top and that they absolutely did not handle things well. They shouldn't have been making some of the loans. The whole idea of no interest for 10 years kinds of mortgages was irresponsible. So coming out and really pointing the blame there, there's a big question mark underpinning that, John, which is where's the regulatory impulse that comes in? I mean, what's the sort of consequence for that mismanagement?
Well, never mind the banks. You know what I was thinking of when that chart was put forward around the internet and on Bloomberg over the weekend? It took 15 years, around about 15 years for the financials to recover from the 2007 peak and a drop off thereafter. What about the internet names? In 99, 2000, how long did that take? It took about a decade for some of those names, Tom?
Forever. And you can take it back to the 70s as well. I mean, lots of these markets take a long time to recover, and subsets can do well within that. But if you're not in those subsets, think JP Morgan is dominant. It's not going to be there.
So I think you know where I'm going next. What about the bust of last year? The bust of last year for some of these major names. Do we face, and I think this is what the likes of Michael Schall and Marketfield, who sits around this table often, is trying to get his hands around. Do we face another decade of very minimal returns because of what's blown up over the last 12 months?
That was the headline from Buffett's, soiree. I'm not a fan of the soiree, full disclosure, but Mr. Buffett made clear, John, he's in that camp where he's worried about the next decade out. I don't want to give an opinion off that, but that's clearly what we heard from the gentleman.
It's part of the conversation. On your equity market on the S&P 500, positive 0.1%. Coming up, Manus Cranny sitting down with Brian Armstrong, the CEO of Coinbase, over in Dubai, I believe. That conversation coming up shortly. From New York City, big week ahead, CPI just around the corner. A little bit later this week. This is Bloomberg. Live from New York City, welcome to the program on TV and radio this Monday morning. This is Bloomberg Surveillance. Here's a flavour of the price action for you on the S&P 500. 4-day losing streak on the S&P into Friday. We snapped that on Friday's session with a decent day of gains, trimming a weekly loss down just a touch after a solid payrolls report in America. This morning, here's your follow-through. Positive 0.1% on the S&P 500. The Nasdaq virtually unchanged. Going through the week, onto Wednesday, US CPI. Onto Thursday, US PPI. A little bit later on this afternoon, 2 p.m. Eastern Time, the Senior Loan Officer Opinion Survey. Much anticipated. Look out for that a little bit later. In the bond market, 2-year, 10-year, 30-year, 2-year looks like this. Even with the move higher on Friday, we were down on the week a touch on a 2-year. Still sub 4% with a lift this morning of 4 basis points, 395.55. And Tom, just to round things out in the FX market, the euro against the dollar. Euro-dollar. Bramo said it was a snooze all week, and she was right. It closed on the week. Totally unchanged last week. This morning, Tom, slightly firmer, 110.43.
Inversion's a little bit easier as well. I'm looking at the 3-month, 10-year spread, and it comes up a little bit less inversion at 183 basis points. Make that 180 basis points. We'll monitor that through the week. Right now, he's one of the clearest speakers within the Bitcoin crypto world. He's a gentleman from Rice University with one of the toughest dual majors in the country, economics and computer science from Rice, and he's made a go of it at his Coinbase. In conversation now with our Manus cranny, Brian Armstrong. Manus?
Tom and team, a very good morning to you. Yes, a highly educated gentleman, co-founder, and he leads the Coinbase organization. You're right, Tom. It is Brian Armstrong. Welcome to Bloomberg. Good to see you.
Thank you.
In Dubai.
Yes.
The flow show. I'm usually on the road tracking bank flows, but I want you to explain to me how liquidity in crypto world looks, as they look to be in the past 24 hours. A little bit of a shudder at Binance. I know you don't want to talk about them. Talk to me about liquidity. What's the flow show like in your world at the moment?
Yeah, well, as you said, I don't want to touch on any other companies in the space, but I can tell you from Coinbase's point of view, we had a great quarter. We just released our Q1 earnings. We did see net inflows in that regard, and so we also saw revenue was up and costs were down. We had a positive adjusted EBITDA quarter. So I think from that point of view, it was a turning point for us in this down market. We were able to generate adjusted positive EBITDA.
That is the perfect CEO answer, but have you cut costs to the bone?
We've cut them quite a lot. We've had actually a really big cultural shift, which I've driven along with our CFO and our COO president. We've cut headcount in January. We've reduced our real estate footprint. We looked really hard at each of our top 5 vendor spends, and we had to rebuild some of our architecture to use CPU and data storage more efficiently in the cloud. So we have a new kind of moment here around operational efficiency at Coinbase.
Okay, in terms of last year's narrative, it was crypto is the inflation hedge. Now I've got people telling me crypto is my security against an unsafe banking system. Do you buy that? Do you have any demonstrative evidence of flow that as a result of SVB, First Republic, and the other impending moments of angst, that you have a material inflow from that debacle?
So look, I think Bitcoin is up about 70% year to date, and so a lot of people, they look with 2020 hindsight backwards, and you always have to come up with some.
That's why I want you to cast forward.
Well, look, I'm never going to make a forward-looking projection of what the crypto prices are going to do. I think zooming out, this technology is really important for the world as a way to update the financial system, and the financial system is slow. The traditional financial system, it's slow, it's expensive, there's not equal access for everybody, and so people are looking for alternatives in the wake of these bank failures, and they're thinking more about how crypto can update the financial system. So from that point of view, I'm long, I'm bullish. Coinbase is going to help that transition happen in the world, and whatever is going to happen in any particular quarter or year, that's not for me to say.
We are pegged to the US dollar, the Yankee, the greenback, but is the US dollar coin now de facto the reserve cryptocurrency?
Well, I mean, the US dollar is
a big part of your earnings.
Yeah, the US dollar is still the reserve currency of the world. Obviously, we have a material revenue generation moment with USD coin, and we'd like to create stable coins that work with other fiat currencies in the world as well. I think it's going to be interesting to see how that evolves over the next 10, 20 years, right? Because we're increasingly living in a multipolar world where the euro and the yuan, and now increasingly maybe Bitcoin or other things could happen over a long enough time frame. But in the short run, I don't think the dollar's reserve currency status is going anywhere.
You're in Dubai. I know you're talking to both regulators. We'll talk more a little bit more about this later on the podium. But in terms of expansion beyond the US, don't worry, I'll get to Gary Gensler in a moment. Beyond the US, what is your ambition? How big can we be in the UAE in your space?
Well, you know, Coinbase, our mission is to increase economic freedom in the world. So that means we really need to do that in many, many countries. Obviously, we started in the US and took a very compliance-focused approach and became a listed company there, and that's been a big piece of our revenue still. But we've increasingly expanded into other major markets around the world. Now what we're doing is we're looking for a home to set up an international hub that could serve the long tail of countries in the world, you know, the Middle East, Africa, maybe parts of Asia as well. And from that point of view, the UAE is very attractive. I mean, the UAE deserves a ton of credit. They're the first country in the world I'm aware of that created a dedicated new regulator to crypto, and they've published a clear rule book, and it's very business forward and protecting of consumers.
But are they ahead by a country mile here relative to the UK and relative to the US?
Well, I would say they are ahead of where the U.S. is. You know, the EU has actually published comprehensive crypto legislation already. The U.K. is on their way there, but I would say the UAE their approach has been more forward-thinking than the U.S. so far.
So we spoke to your CFO, you're the CEO, the Wells Notice. Everybody, you know, is sort of digging around for news here, and I sat down and thought, what is this Wells Notice? Is it an Armageddon moment, potentially, for Coinbase in the United States of America?
I think this moment is really an opportunity for us to finally get some regulatory clarity in the United States. And we're happy to do that, by the way. I think it's a great role for us to play in the industry and for America.
You're going head-to-head with the SEC.
Well, that's true. I mean, look, we don't relish the opportunity to be in litigation with one of our primary regulators. We've sought out regulation all over the world and tried to be proactive when there wasn't clarity. But if there's no clear rule book in the U.S., we created our own best practices to evaluate, you know, over 1,000 assets, and we rejected 80% of them. The 200 or the 20% that we list, we believe are commodities, and there's been no clear rule book. And so if we receive a Wells Notice, I feel like we have a duty to push back and go seek case law that will help bring this clarity to the U.S.
I mean, I fiddled around with this question for about 2 hours. SEC, CFTC, what is the question you ask the CEO? And here's the question. Are these regulators still fit for purpose?
Well, I think there's certainly a role, yes, because crypto is many things. Crypto has commodities. Crypto has some that are securities. We don't list them, but there are some out there. Yeah. We think there should be a robust, healthy market for that. There's also stablecoins, which are more like currencies. There's artwork, you know, with NFTs. And so crypto is going to have a number of different regulators. It probably is going to need new legislation to be passed in the U.S., and the good news is there's broad bipartisan support in Congress for that exactly to happen.
Can you see a day where you go, look, troops out, I'm gone from the U.S.?
We're not going to leave the U.S. You know, we do have a choice of where to invest our dollars around the world in any given moment, but we're not going to leave the U.S. It's an important market, and the good thing about the U.S. is there's rule of law, and so we do reach the right outcome eventually.
Now you've got a new license in Bermuda, and what goes through my mind there is, are you going head-to-head with Coinbase in Bermuda? You can do a lot more and a lot more scale in Bermuda. What is the objective there? Is it to go head-to-head with CZ?
No, so it's international expansion. You know, Bermuda.
That's a very broad term, Brian.
Well, that's true. I mean, we want to have coverage broadly around the world. Bermuda is a great region to sort of serve the Western Hemisphere, if you will, outside of the U.S. But we also are very interested in the UAE to serve this part of the world. I think there's great access to not just the Middle East, but you know, Africa, other parts of Asia. And so the UAE has been very business forward, and we're interested in speaking with people here too.
The institutional side of the business is where I want to get your sense. When we were sitting over there, we were chatting about the ETF, the approval of the ETF. I mean, is that the turnkey moment? Is that the Goldilocks moment for you on the institutional side of the business? What would that mean for you if that gets regulated?
Well, if an ETF were to be approved in crypto, which it probably should be, by the way, that would drive a lot of new capital inflow from institutions. I think that would be very good for the world. For our business in particular, I mean, there's a lot of things that we're doing in the institutional space. We have 25 of the top 100 hedge funds in the world are customers of Coinbase Prime, our prime brokerage for institutions. We also have seen a lot of inflows, and I mean, frankly, we also purchased One River Asset Management, so we now have an asset management business we're developing in the institutional space.
So you've got skin in that institutional game. Are you actively now wanting to build out bigger institutional capacity?
Absolutely. I mean, we have an amazing institutional business. I think it's the best in the world in crypto. We're going to keep growing that, but we're also going to grow the retail side.
So this is full bull story. Come on, there's got to be something that causes you to flinch at night.
I mean, I think
the banks. No, you're not bothered about the banks.
A healthy degree of paranoia is always good for every CEO. You always want to be rigorous. But I mean, the bank situation. Actually, I think Coinbase is in a pretty good place here. There certainly was, there were some bank failures in the U.S. and we have about 5 different banks that we were working with in the U.S. 2 of them had issues. We've now kind of reestablished back the level of redundancy that we would like to see in the U.S. But Coinbase, we work with some of the biggest banks in the world, GSIBs, and so I think we're in a healthy place on that. But we need to make sure we're vigilant on that.
Brian, it's always good to have a healthy little bit of bounce in your step. Brian Armstrong there, the co-founder, the CEO of Coinbase. We're going to go on stage. It's a much gentler ride on stage.
Good.
Don't worry about that. Brian Armstrong, our guest today from the UAE, to the surveillance team in New York. Good morning.
Hey, Manus, good morning to you. Thank you, buddy. Manus just trying to make sure that his guest doesn't run away. Out of their panel conversation a little bit later.
I've been in the same position, John. You do a chit chat interview, and then you're going to go up on a stage, and you got to do further chit chat. And
sequencing is important. You do the warm fuzzy stuff on stage, and then you slap them around in a proper news conversation afterwards.
He mentioned.
I'm sorry, you thought we were friends. Oh, right, okay.
He mentioned exactly. He mentioned the cost cutting that they're going through. Let's remind ourselves we've enjoyed this stock from 350 down to 58. And, it's trading in I'll call it a range of 50 to 70, 50 to 80 as well. But they're reinventing themselves. And to me, the crux of this, John, is they're basically being kicked out of America. Maybe that's too inflammatory. But Gensler's saying, this is difficult. I'm not sure where this is going.
And Manus asked a delicate question that he didn't want to answer. Elisa, is the regulator fit for purpose? I think a lot of people have an opinion on that at the moment.
Especially whether or not they want to legitimize this asset class. Meanwhile, remember when we were talking about how this asset class was a symptom of the froth that was built up over the past, 10 years, et cetera, and now kind of it's coming back again. It's sort of this muddle that we're in that just continues throughout 2023.
Your latest sport update coming up next with Ian Shepherdson of Pantheon Macroeconomics. You just know TK is going to mention something about Newcastle. We'll try and ask him about the Federal Reserve and the recent data as well. On the S&P 500, positive 0.1%. Just a reminder for the calendar for the week ahead. Wednesday CPI, Thursday PPI, a little bit later on this afternoon, the Senior Loan Officer Opinion Survey. Look out for that from the Fed. From New York, this is Bloomberg.
You don't put an Aston Villa.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there's no good alternative to Congress lifting the debt cap. She also told ABC that the use of the 14th Amendment would spark a constitutional crisis. President Biden is scheduled to meet with House Speaker Kevin McCarthy and other congressional leaders tomorrow to discuss the debt ceiling. A new poll shows President Biden's approval rating hitting a career low. It also shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44 to 38. Russia reportedly has at least 300,000 troops inside Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. Germany's Chancellor Olaf Scholz and France's President Emmanuel Macron reportedly plan a charm offensive. According to a German newspaper, the goal is to reset the relationship following criticism that ties have crumbled. Macron is said to be planning a state visit to Germany in July. And in Saudi Arabia, the economy expanded at a slower pace in the first quarter of 2023. That was due to the oil sector, which grew at its lowest rate in more than a year. Saudi GDP rose an annual 3.9% in the first 3 months. That compares with 5.5% in the previous quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This is 12 reports in a row that Wall Street has been surprised to the upside. Guys, maybe you should change your model a little bit. That's 12 in a row. That's never happened as far as the chart I saw today. So this is a very tight labor market. It's going to take a while to cool it off. And I think we have to be patient on that dimension.
Jim Bullard of the St. Louis Fed often tunes into Bloomberg Surveillance. This was exactly the conversation we were having with Mike McKee just last week. On the day that payrolls comes out, we've had upside surprise after upside surprise going all the way back to last April for the March payrolls report of 2022. TK, from there on the day the jobs report has come out relative to estimates, we've just had a series of upside surprises which continued through Friday.
To our team working through the weekend, that was a perfect shot to play. What if we get a Bullard Fed? What if we get a market that reacts to a Bullard Fed? And that's where the short-term paper begins to go from, say, LIBOR 530. SOFR, I think, is 5.04. Bring them up 50 basis points. That's what Bullard's saying. Make that short-term paper market even tighter. The
reaction and function of this Federal Reserve has shifted somewhat. There is a belief now that the bar for subsequent hikes is now higher than it was maybe a couple of months ago. Lisa, it's going to be more than just about the persistence of the data. You'll need the bank stress to fade over the next couple of months to reintroduce this concept, I think.
Without a doubt. I mean, that's the discrepancy, right, that we're seeing with rate hikes, rate cuts, I should say, priced into the market versus economic data that has surprised to the upside at the fastest pace going back more than a year. If you look at the Bloomberg Economic Index that tracks this. So at what point do we start to see some sort of consensus consolidate around the banking stress either going away or reigning sort of predominant in this narrative?
A June decision is just really tough. You've got the bank stress on top of the debt ceiling mess. On top of the fact that this is basically what you implied in the previous dot plot, which was 5.1% and then pause. TK, for a June hike, you'd have to believe the bar is pretty high.
And they're going to get... No, I don't. I just need to wait for the data. I'm data dependent. Data? I think the jobs report that we're going to see, I'm looking right now. I'm getting out there. I didn't feed my Bloomberg mouse this weekend. It's not going as fast as it could. Anyways,
what are you after?
Early June. There's a jobs day. Can you imagine if we get a jobs day like what we got on Friday?
Yeah, I don't think that's sufficient.
Yeah.
I don't think that's sufficient for another hike.
I don't know.
Because of the banking stress.
Precisely.
Exactly to that point, which is the reason why the market ignores whatever they say that could potentially fuel the argument for a rate hike or no rate cuts, and they just focus on what confirms their narrative.
But I'm with you. If you go a few weeks without a failed bank, then the market's going to change its attitude towards the economic data. I mean, we've gone about 1 week today. Let's try and go another week. And Tom, then the data takes on more importance.
Yes.
And when you look at the totality of the data, whatever that means, the weight of where the focus should be will shift somewhat away from financial stress and back towards traditional indicators. But I go back to that line from Brett Ryan at Deutsche Bank. We've lost that hike in feeling, or rather they've lost that hike in feeling. That seems to be the conclusion for a lot of people on the street right now around the Federal Reserve.
I think Bullard said it best. They're completely divided. There's a whole group out there. And, I'd really listen to some of the people working very hard to think through stability here or a higher, more persistent rate regime. The key sentence I heard from Mr. Bullard is it's going to take a while. And that's that x-axis moving out. We talked to Randall Krosner about that on Friday. The heart of the matter is, okay, maybe there's a job vector that gets you to rate cuts. Maybe there's this, maybe there's that. But the market wants it, say, middle of July, August description. What if it's October? Or dare I say January of next year, where everything is more gradual to get to where the market is.
So here's 2 quotes for you, Tom, both from Bank of America, one from Mike Gapin, another from Ethan Harris. They work closely with each other. This was from Mike Gapin. I think this contributes to the conversation that you're having, Tom, at the moment. It's difficult to argue the labour market cooled. The report reinforces upside risk to the near-term monetary policy path. A hike in June cannot be ruled out. Mike Gapin on a similar page to you, Tom. This is what Ethan Harris has got to say. There has been only limited progress in bringing global inflation down with almost no real pain, while investors are trying to look towards a more normal period ahead. Ethan goes on to say, first, the rebalancing actually needs to happen. There are some people, Lisa, out there pushing back at the moment.
Well, they're pushing back, and we're not seeing it in the pricing. And what people will say, the reason why you're still seeing rate cuts priced into the market is because people are having these tail risks, right? Either something will happen catastrophic that we can't foresee, and the Fed will be forced to cut by 100 basis points or 200 basis points like that. And other people saying, well, there's a good chance that they're going to have to stay where they are or even hike further. I just keep going back to economic data that keeps surprising to the upside, to inflation that has remained stickier. We saw that employment wage component continue to surprise to the upside in the labor market data. At what point do we end up sort of second guessing, Tom, this idea of whether perhaps we're being a little too flippant about the weakness and the imminent doom that some people talk about all the time? Like
we discuss the dynamics right now. Let's get to it with Ian Shepherdson, Chief Economist, Pantheon Macroeconomics. Ian, how have you adjusted your American economic call over the weekend?
No, I haven't. I mean, the headline payroll number Friday was quite startling, but the revisions were also startling, and they were all to the downside. So stepping back from the noise, look at the trend. Payroll growth has been slowing kind of relentlessly for the last couple of years. We've kind of lost that post-COVID catch-up hiring, which was generating numbers like 600,000 a month, and now the trend is less than 200,000. And it's slowing pretty consistently, and most of the leading indicators suggest it will slow further. And also, just bear in mind, history tells you, if you look at the last few US economic cycles, we go from 200,000 a month and everyone's saying, everything's fine, to, oh, zero. How did that happen? Usually in 3 to 6 months. It tends to happen fairly quickly when the turn comes, and I do think that we're kind of on the verge of that now.
So do you think that right now we are on the verge of an immaculate disinflation, a sort of soft landing that a lot of people are talking about, I believe yourself included, or do you think that there is something more pernicious under the surface, especially with the Fed holding rates where they are?
Yeah, I mean, before SVB went down, I was very much of the dodging the recession and getting inflation down, pretty great scenario story. But I do think that the tightening of credit conditions in the wake of the bank failures is going to be a very big deal. Small businesses are already squawking about it. The NFIB, the Small Business Survey, is at recession levels already, and it was there before the banking crisis. And so I'm very nervous about what it's going to show in the next couple of months in terms of credit conditions. And, small companies employ more than half the workforce. They do an awful lot of capital spending. They carry a lot of inventory, and all those things are going to become much more difficult, much more expensive for them. So I can see a real kind of bifurcation now where the large corporate sector does okay, but the small business sector, which is kind of hidden from view most of the time, is really going to struggle in the wake of this bank tightening because they're just captives of their banks, effectively, most small companies, and it's going to be a much more difficult environment. So now, unfortunately, I think a mild recession is the most likely outcome.
Do you think that we're overestimating or underestimating the role that small banks play in the U.S. economy?
Oh, I think it's almost impossible to overestimate because they account for well over half of all the lending to commercial real estate. They account for about half of all the lending to commercial industrial companies. And for a lot of small businesses, very small companies in particular, they're just captives of the bank. The bank is the only source of external finance apart from the owner's pocket. And when banks are raising credit standards, they're raising spreads, they're raising credit scores, they're making it more difficult to get asset finance, more difficult to get working capital. It has a very profound impact on the ability of the small business sector to continue to operate. So, of course, we get very little data. Most of the data we get is whole economy numbers or big company surveys or big company data that we get through earnings reports and all the rest of it. But if you really look below the hood at what's going on in the small business sector, there's some very alarming trends there already. Their capital spending intentions are rolling over. Their own perceptions of credit tightness jumped dramatically in the wake of SVB going down. And we get more information on that tomorrow. It's not going to be good. And it's very easy to kind of ignore them because it's so much easier to focus on the large corporate sector. But most people work for small companies.
Ian, big question. It's all we want to know from you. Were you at the game this weekend?
I wasn't, no. Just good for my nerves.
They lost, Tom.
I saw
to
it.
Arsenal.
I watched.
I saw that too.
I see, what I don't understand is that Newcastle's the only place where they all take their tops off.
Doesn't matter what the weather is.
It doesn't matter what the weather
Freezing
is.
cold.
Can you just see Shepherdson there? I can see him,
Ian's a hooligan.
It was very warm yesterday.
40 degrees, 5 rows up. Shepherdsson's 5 rows up naked by the
Ian's a
half.
hooligan. Ian Shepherdson of Pantheon Macroeconomics. Ian, thank you. I can tell you a story. I think I've told you this before. Boxing Day, day after Christmas. It was Newcastle West Brom. That's a team in the Midlands. Freezing cold. Absolutely freezing cold. Newcastle fans behind the goal at the one end. Tops off. Tops off. Just seriously, they are some of the toughest fans out there. Yeah. And they turn out in force for every single game. It's so impressive.
The experts on NBC, thank you for your great coverage. I hate when it's on Peacock, but not to get into that sidetrack. But, John, what I find interesting here is it right that big money took over Newcastle?
Some Saudi money.
They're ahead of schedule.
They're being responsible. Yeah. They're not throwing it around in the way that maybe Chelsea did 20 years ago, Manchester City over the last decade. They've been responsible about that so far. Not to get stuck in something we shouldn't be talking about.
Somebody emails.
God forbid.
Somebody emails in.
Do that. No, we never do
Somebody
that.
emails in and says, how much beer are they drinking at Newcastle to stay warm?
It's just a fair bit of ale, Tom. David Leibovitz of JP Morgan up next.
We're very far away from what these job market reports need to start to look like.
We keep printing lots of jobs. People have got jobs, they got money, they go out and they spend.
We just think that this market remains fragile and vulnerable, and we're looking for another 5% or so pullback from here.
The U.S. is settling down while the world is holding up a bit.
12 months from now, we think the Fed is aggressively cutting rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive 0.1%. Another big week ahead. TK CPI just around the corner. A little bit later on this afternoon. A bank lending survey which has been much anticipated for weeks now as the banks run into some more difficulties over the last couple of weeks.
I agree with your take that this afternoon really, really matters, but I've got to be focused on inflation. What I'm hearing off of the shock of Friday's jobs report, everybody starting with Governor Krosner on Fridays moving out their x-axis. We heard it from Bullard in the last hour as he talked to the Minnesota people. And the bottom line here, John, is that inflation report, it's been underplayed in all the bank exhaustion we have. Guess what? Wednesday matters.
Are you suggesting it won't be too long before we're talking about hikes again in June?
I am suggesting that the rate cut mantra is in full swing, and boy, was there a pause at 8:30 on Friday.
The data's pushed back against that. Stuart Kaiser of Citi had this to say over the weekend. Markets were risk-off for the week, but we are very surprised by the rally on payrolls. Lisa, investors seem happier about not bad growth data than concerned about hawkish wages.
I would agree with that. And that was a surprising response to economic data that was better than expected, because we have seen over the past few months, people then were worried about rate hikes, further rate hikes, the Fed going further. The Fed doesn't seem to be back on the table in any way. People basically saying, well, the banking stress will take care of that. And good news is good news. So at what point do we get the Fed come back into play? Or is this the new reality that basically we're going to have rates stay where they are for a prolonged period of time and the economy will continue to surprise to the upside?
Have we taken care of the bank stress? $10 name. PacWest last Monday dropped hard through the week. Right now in the pre-market, $7.60, Tom.
As a general rule on a single, below $10 stock, the media loves to focus singularly on percent change. And I just think it's got to be more sophisticated than that. And the answer is, I don't know if you got this chart in the control room. Talia, bring it up if you can. She crafted this brilliant chart which shows the resistance, John, that they've got to get through here going 7, 8, 9, 10 and such. They're nowhere near breaking through the resistance of the last 7 days or so. On radio, it's simple. It's 1 price decline, 2 price declines, 3 price declines. Yeah, Friday pop-up.
We had this experience, Tom, in the Eurozone in the debt crisis. You had the Greek banking names.
Yes.
They became so low in price, you just stopped quoting percentage change.
Yeah, well, that's what adults do. They don't quote percentage change, but the answer is that feeds the emotion that sells newspapers.
You know what adults do? They quote Dow points, Bramo. Don't forget it.
Thanks, I appreciate
it. Hey, 3M may leave Minnesota manufacturing and mining. They're talking about it may leave the Dow.
Wow.
Which would be...
Pushed or jumped?
Pushed would be it. Like a lot like John Anaconda Copper a few years ago.
Yeah, good story that.
We're crushing it.
Just go straight to the market. Equity futures on the S&P 500 up by 0.16%. Yields are higher by a couple of basis points. Lisa, 346.16 on a 10-year.
Today, we're fully trained on 2 p.m. That is when the Senior Loan Officer Opinion Survey from the Federal Reserve will be released. And then people will come up with the reasons not to care about it. I will just say, pre-market trading, PacWest shares surging 32% and Comerica shares surging 7%. Look, they're still pretty deeply depressed, to Tom and John's point, but we are seeing a little bit of a rebound this morning as people try to gain some optimism around that sector. Tuesday, tomorrow, U.S. President Joe Biden is meeting with congressional leadership, Mitch McConnell as well as Kevin McCarthy. Debt ceiling. Why are we not talking more about it? It seems like it's a problem.
This is big meetings tomorrow.
This is, yes, and this
that.
is a really important meeting. How much consensus can they come to, especially if Janet Yellen is correct and we run out of money on June 1st? And then on Wednesday, we do get CPI, followed by PPI on Thursday. Do we care if it's an upside surprise? With the wage data, we got an upside surprise in the data on Friday, and people didn't seem to care that much, maybe a little on the margins, but it really hasn't shaken the underpinnings of the market the way that I expected.
It's not Europe, but they care. I'm sorry. I know we've gone from 8-9% down to 5%. That's not like Germany. It's not like the United Kingdom, but still, these rates are totally unacceptable. They care about the dynamics.
With us around the table, David Leibovitz, the global market strategist at JP Morgan Asset Management. David, good morning to you.
Morning.
How long before we're talking about a June hike again?
So it's interesting, and the point that I think you all were discussing prior to the break, I think is really what investors need to focus on, which is everybody's expecting that the Fed is done. Everybody's expecting that the Fed is going to start cutting rates at some point in the back half of this year. If you think about where the risk lies relative to that view, it very much lies to the upside, right? So the risk here is that people find themselves flat-footed. I would agree with you on the inflation point. The rate of inflation is entirely too high. Not to mention Powell's favorite indicator continues to trend higher, right, which nobody's really talking about. And so, is the Fed going to do 4, 5, 6 more 25 basis point hikes? Probably not. But if you're thinking about a portfolio and you're thinking about what could give the market jitters going forward, I think it very much lies in that upside risk around the Fed doing more than the market expects. That could even be staying on hold, given the way futures are priced today. But again, very much view the risk as being to the upside.
Equity leadership. Where does it come from, if that's your backdrop?
So I think, the interesting thing that we've spent a lot of time talking to clients about is, back in March when we started to see stress in the banking system, why aren't equities going down? And the answer was the 10-year fell 50 basis points, and that boosted all of the tech names, and that allowed the S&P 500 to keep its head above water. I don't think you're going to see the market broadly, do particularly well in that environment because the big heavyweights in the market are just too sensitive to the overall movement of rates. And so I think what you end up seeing is kind of a nowhere market, right, where the average stock arguably starts doing a little bit better, maybe some utilities, healthcare, staples. But, tech's not going to lead us out of this hole if the risk to rates is to the upside.
I want you to talk about this because you're going into institutional and high net worth people and they're scared. You know what? The bottom line here is the rest of the market, as witnessed by the SPX, has come out of a brutal bear market in October, and it's made back a huge part of that loss. I think that's underplayed by people addicted to covering Apple every 15 minutes, breathless. Do you look at this as the bottom of a market in October, and we're climbing out of it into a positive return for everything else besides Apple?
So I think at the end of the day, the problem with saying that October was the low is it reminds me of people telling me that June was the low, right, in the middle of last year. And we had priced in a recession because the median decline, is 25% peak to trough. And we did that, right? So we must have priced it in. But let's talk about the growth data. Let's talk about the jobs report. I mean, this is not an economy that is anywhere close to being in recession, in our view, when you look across the board. I don't think we necessarily set a new low, but we could arguably retest those existing lows at some time before the end of the year.
So is good news again?
I think good news right now, it's an interesting question because the market has shifted its focus away from inflation and back to growth. And on the one hand, that's allowed the negative correlation between stocks and bonds to take hold again. And so market performance this year has very much been better. But I worry that if the inflation data doesn't cool off, then good news becomes bad news because it means that the Fed is going to have to do more. So we're in this kind of weird nebulous state today where it just doesn't seem to us like investors broadly are accurately pricing in the risks around monetary policy that we see on the horizon.
If there is another bank failure or another bank jitter that emerges, does the data matter about inflation, or do people basically discount the Fed no matter what?
So I think that's the problem, and that's what's happening today, is that people are saying, look what's going on in the banking space. It looks and feels and smells like something we may have seen before. The Fed's going to have to go on hold. But, again, I would make the point that banks fail every single year. Right? It's just not usually the 16th largest bank by assets. And that's what really caught people's attention. And so, I think we could see continued stress in the banking system broadly, but very much at the lower end as we work through some of these COVID excesses and we work through the duration mismatch that we know exists today. I'm not sure that we're out of the woods, but I do think that the big booms have probably been heard.
I don't want to get in trouble with Mr. Diamond. He hangs on your every word. But the bottom line is, are we going to see a banking roll up in this country? Keep J.P. Morgan out of it. Are we going to see see a banking roll-up in this country.
Well, I think what's interesting that really ties back to the structure of the U.S. banking system, right, which is much more fragmented than what you see in other parts of the world. And so arguably that caters more to M&A activity than would be the case in some place like Europe. I think it would be premature to say that we've seen the end of consolidation in banking.
He read, that's like when Powell's in his press conference reading off the piece of paper. David did that. He just absolutely nailed that.
I'm pleased you mentioned the bank failures and how much more regular they are relative to how much they get talked about. The FDIC has got a nice little table. You can access it easily on Google. I just did. 2017, 8 banks in America failed. I don't remember talking about it in 2017. 2024 went under. 2019, 4 went under. There's a reason, and you've pointed it out. They're that much bigger this time around. And there seems to be a feeling that perhaps that can bleed into and towards a credit crunch more broadly. Do you have those fears that we do get that credit crunch ultimately, and that's why you shouldn't be pricing in higher rates off the back of this robust data, because ultimately the banks are going to take care of business?
So I think that you do get a further tightening in credit conditions, but I think the mistake that people are making is they hear the word bank and they think 2008. And structurally, this is a very different issue than what we were dealing with 15 years ago. And so could the market, right, we're back to the market doing the Fed's job for them, could the market do some additional tightening, and maybe that means the Fed doesn't need to continue hiking rates? Absolutely. I wouldn't be surprised to see that occur. You're actually already seeing, right, in some of the more cyclical parts of the economy, things like manufacturing, cracks begin to form. But is the banking situation in general going to, get the Fed to do a complete about face? I think that that's a bit of a risk. I think if anything, it speeds up any potential rate cuts later on this year. But I still think summertime for easy monetary policy may be a little bit premature.
David, appreciate it. Thank you, buddy. David Leibowitz there of JP Morgan Asset Management. Coming up a little bit later in the program in the next hour, Rob Waldner of Investo. In about 5 or 10 minutes, we'll catch up with AMH down in Washington, D.C. Anne-Marie's thoughts coming up on this poll right here from the Washington Post ABC News poll over the weekend. The percentage of those approving of Biden's performance has fallen to 36%.
Got to address it.
6 points lower than in February, a point off his previous low in early 22.
Back to early 22, but my basic answer is anytime you have a president under 40%, you got to be talking about it. I mean, that's stunning.
For a long time, we talked about him having an edge over former President Donald Trump. Bramo, not in this poll.
Which raises some questions. What happens if he starts to lose against him? Who do they have in the wings?
Are they even going to have a contest? Never mind who they've got in the wings.
But that's my issue, right? If there is no other frontrunner, what do they do with that?
Anne-Marie coming up in about 5 minutes. Look out for that conversation just around the corner. Equity futures on the S&P 500 positive by 0.2%. Getting your week started here in New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there are no good options for solving the debt limit stalemate other than Congress lifting the cap. Yellen told ABC that the White House resorting to the 14th Amendment would provoke a constitutional crisis. President Biden discusses the matter with congressional leaders on Tuesday. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. The 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest that was jammed with ammunition. Japanese Prime Minister Fumio Kishida has visited a landmark visit to South Korea. Now, he met with President Yoon Suk-yeol and pledged to seek cooperation on high-tech goods. Kishida said the trip helped, quote, deepen the relationship of trust. The visit marked the first formal summit in Seoul between the neighbors in a dozen years. It's a holiday in the UK following the weekend coronation of King Charles III. The crowning ended Charles's 7-decade wait for the throne. And it marked a turning point for the UK and the monarchy as he tries to adapt to the current era of technological and social change. The king told a packed Westminster Abbey that he had come, quote, not to be served, but to serve. And President Biden will announce that the government is drafting new rules for airline benefits for stranded passengers. Carriers could be required to provide meals, hotels, and additional compensation due to canceled or severely delayed flights. Authorities say they expect air travel this summer to surpass pre-pandemic levels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There is no way to protect our financial system and our economy other than Congress doing its job and raising the debt ceiling and enabling us to pay our bills. And we should not get to the point where we need to consider whether the president can go on issuing debt. This would be a constitutional crisis.
That was Janet Yellen, the U.S. Treasury Secretary, speaking on ABC over the weekend. Congress has a job. Her message: to get it done. We'll get to that in just a moment. From New York City this morning, good morning on TV and radio. Here's the price action for you on the S&P 500, positive by 0.2% to build on the gains from Friday, and decent gains they were off the back of a strong payrolls report relative to expectations, pushing two-year yields a little bit higher. The follow-through this morning, positive on futures, yields a little bit higher on a 10-year by a couple of basis points, 346.35. The euro did absolutely nothing through the whole of last week, 110.49 on the euro against the dollar right now, positive by 0.3%. The poll that we've been talking about, though, here are the details from the Washington Post ABC News poll released over the weekend, showing the president lagging Trump in early voter preferences. The percentage of those approving of Biden's performance has fallen to 36%, 6 points lower than in February and a point off his previous low in early 2022. And let's address the elephant in the room, because this poll did. 56% disapproved of his performance, 68% regarded Biden at 80% as too old for another term. On the question of whom voters prefer for 2024, only 44% viewed Trump 76 as too advanced in years.
Yeah.
Participants also rated Trump's physical health and mental acuity as higher. Tom, what's amazing to me is that we're having these conversations out loud going into this race.
I agree with you on the out loud, but it's also the original moment we have of a former president, I believe 78, and a present president 80, and everybody can do the high-end calculus to get out 4 years from 2024. Anne-Marie Horton has done the math. She's our Bloomberg geriatric correspondent this morning. Anne-Marie, look, I'm going to cut to the chase here for our international audience. You, I, John, and Lisa witnessed the president at the White House Correspondents' Dinner. It's clearly within the zeitgeist, and the answer is 68% worried of his age, and I believe for the former president, it's only 44%. What does the White House do this morning?
Well, I think what they do is what he did at the White House Correspondents' Dinner, which is making sure that he is active, he's in front of the public, and he's on cameras giving speeches. He just gave an interview Friday very late in the evening with MSNBC. He's going to be having an event today at the White House, and I think this is a way they can try to combat the fact that people think he's too old for the job. If he steps up and does the job every single day, that's one way they can see potentially changing some of the public opinion polls. You know, the president, though, does have a sense of humor. He joked about his age at the White House Correspondents' Dinner. He says, you know, they say I'm too old. I say, listen, I'm wise. He feels that he is fit for this job. He is currently doing his job, doing the travels, everything that is needed. But obviously, many people are concerned, given the fact that he is the oldest president in history. He would be 86 at the end of that term if he were to win in 2024.
Is there a mood of a reshuffle at the White House? Is it the idea of getting in fresh bodies to support a president on that election charge?
Well, obviously, the campaign will have fresh minds and individuals. Inside the White House, we have recently seen a number of changes with the chief of staff, with the head of the National Economic Council. But I think that is less about Biden and re-election and more about just the cyclical pattern of an administration, right? People do tend to move on after a year or two and go do something else because these jobs are incredibly time-consuming and taxing. But there is some interesting fresh faces at the White House. He's also bringing some people that he trusts closer involved inside the White House as he looks to finish off these next 2 years and he becomes a candidate for 2024.
One of those people potentially is Kamala Harris, and she was on stage with him at the White House Correspondents' Dinner, the first time that a sitting vice president has been on that stage with the president going back to 2016. Is that important in terms of the messaging going forward for this election and her role that she'll be playing?
I think so. I think they want to make sure that the vice president is out there on the cameras the same way you see the president. Also, the president spoke about her in his interview with MSNBC, saying that she's done a fantastic job. I think many people in the White House think that she is underrated with the public. She has not polled well either. Potentially, though, she has been leaning into the issue of women's health and abortion. That was a huge issue for the midterm elections, is going to be a big issue for 2024. And they think that she is the right voice to talk about that. And potentially, this could help their campaign.
Is anybody happy about a redux of the prior election of Trump versus Biden?
I don't know. I'm looking at these poll numbers. I don't see many people that are happy about, I'm not going to, speak for all of American people, but the 1,000 individuals that were surveyed on this poll doesn't look too happy that these are the two candidates they want representing either party.
They're still close to 18 months, right? It's still a long way away. Let's see if this is the outcome.
I know for you, John,
in
in the UK, this timeline is just feels like forever, doesn't it?
But MH, we can play with it. Let's imagine this is the face-off. Round two, so to speak. The nature of this president's campaign has got to be so different to the nature of the campaign that he conducted through the depths of the pandemic and beyond, where effectively he could hide and make it a referendum on President Donald Trump. Anne-Marie, you'd imagine he can't do that this time around.
No, one, he cannot hide, and he's not, but he's going to be out and about doing what he needs to do as president, and he's going to have to obviously pick up some more events. I know he's going to New York as well this week. He's going to have to be meeting with donors, going to have to be meeting with the Democratic Party on top of the normal, everyday items, meetings that the President of the United States has to have, including the foreign travel. Second, it's not a referendum on the former president. They'd like it to be, but it will be a referendum on the current administration.
AMH,
it makes it much more difficult.
Before you run, can I just squeeze this in? Can you give us the timeline for the next week or so? There's a meeting tomorrow between congressional leaders and the president. What should you be looking for? What should we be looking for in the next 24 hours, 48 hours?
Tomorrow's a huge meeting. I think what really matters is when they walk outside and they go to the cameras on the North Lawn, what do congressional leaders say? Most notably, Speaker McCarthy. Does he come out and say there's a path forward for this? Or do the battle lines, do the red lines, do they get hardened after tomorrow's meeting? It really is a critical meeting because that timeline is getting shorter and shorter. We are less than a month away from what the Treasury says is the X date.
Looking forward to your coverage, Anne-Marie. Tremendous as always. Anne-Marie Hordern down in Washington, D.C., our chief Washington correspondent on the latest. Let's talk about it. You talked about being exhausted, Lisa. Never mind being exhausted. So many people are frustrated with this topic, particularly on Wall Street. They can't find an edge. They've got no read on what's going to happen. It's one of those things, Tom, that's important to markets, but you don't really know what to do with it in anticipation of it, apart from the at-risk maturities in the T-bill market. It's like, what do I do with this?
The heritage of this is certitude. It's no big deal, except there was, I believe it was 2011. Oops. And all of a sudden, on an afternoon, I remember it. I was out. I was gone. I was, in my, shorts and T-shirt and bow tie, and they said, you got to come back into the studios. That's how bad it was. 2011.
You can't tell a story that starts like that. No. Shorts, T-shirt, and a bow tie.
Bow tie. I'm out. It's like I'm walking around Central Park with Vet Bill, and they said, you got to come back to the office immediately.
So he did it with a cigar?
I brought the cigar in, and they got angry. But the answer is 2011 surprised everybody. It's like, oops.
As a base case, Tom, can we conclude that this will lead to spending cuts and ultimately should contribute towards slower growth?
I don't buy that. I think it's an arch debate over the conservative, almost religiosity of spending cuts versus tweaking the growth of spending. Those are two widely different things. Lisa's much more up to this than I am.
Well, no, it's a frustrating debate for everybody because it's got no positive side to this. There's no positive to have this hashed out in this kind of forced, contrived manner that puts the U.S. credit rating at risk. And what this shows is a complete inability to get things done and, frankly, a lack of vision when we're talking about what can you herald, et cetera. We are in a muddle, but where is the vision to try to put something forward?
There isn't a vision.
It's frustrating.
The core conservative ethos here is it's a huge positive because their core constituency really cares about this, and they want less government. That's all there is to it, as Ronald Reagan, would mispronounce in America. That's what they want. That's all there is to it. And they're speaking to their core constituency.
It's religion until you get in power, and then it's like
and
separation between
this
church
goes
and state.
back
I don't
to
believe in that anymore.
The mythology that we remember from Ronald Reagan.
Well,
If you ever tune in on the weekend for Premier League football at the start when the players are lining up, I don't know if they're playing a song when that happens, Tom.
We do that. The kids come in,
But
we
they
walk
cut
in
to
with
like
the kids.
they cut to the betting gods on one side of the screen.
Yeah.
And then you see the players shaking hands, and you get a vibe. You know, you pick up on the vibe of the game, and it's sticky. You don't turn the channel; it's sticky.
Yeah.
We need that for Bramo in commercial breaks. After that
bad.
debt ceiling conversation, Lisa, you wouldn't even need the volume up. You wouldn't need the volume up.
No,
it's just
Bramo
frustrating.
She looked
coming
like
through
she
the
was
screen.
landing a plane at JFK.
It's frustrating because it's just a disingenuous conversation. When Trump was in office, he raised the debt ceiling. There was no problem with it. Nobody had an issue with spending. And all of a sudden now we have this massive issue and we're possibly going to default. And oh my goodness, everyone's going to put their pet project in there and then we're going to bring us to the brink and no one knows what to do with this. And it's annoying because it doesn't have to be this way.
In politics, it works for both sides, doesn't it?
Always, but it's just frustrating. Ugh,
Okay.
I'm done.
All right, you take a breath. That was good. That was fun. That works.
Was it?
No. The equity market on the S&P
I'm just
500.
gonna walk off.
Last week, losses Monday, Tuesday, Wednesday, Thursday, gains on Friday. The gains on Friday off the back of a robust payrolls report. We add to them just a little bit, up by 0.2% on the S&P. The Nasdaq totally unchanged. In the bond market, 2-year, 10-year, 30-year, looks a little something like this. The 2-year still sub 4%, but getting there, getting closer to that 4 handle. We're up by 5 basis points on a 2-year, 396.58. You know all about the data for the week ahead. If you are just tuning in, welcome. Here is your data for the week ahead. CPI Wednesday, PPI on Thursday, Senior Loan Officer Opinion Survey comes a little bit
It's a
later on
big
this
deal,
afternoon.
right?
2 p.m. Eastern Time. Big deal because we've been talking about it for weeks, Tom. I think Bramo said May 8th at the end of March. That's what we've been waiting for, right? May
But
8th.
then it's going to come out and people are going to be like, oh, it doesn't really matter. Because
Well,
it doesn't really
Chairman
track the actual data.
Lisa, you'd have to think Chairman Powell had a read on that already in the news conference last Wednesday, surely.
And he said basically it showed what we already expected. And this is just gradual credit tightening from the rate hikes, not necessarily some sort of fissure in the market. We're also looking at some of these single names. There have been a number of earnings that have been coming out throughout this week, throughout this morning, including Tyson Foods, which this actually is telling. This tells you something about the economy. Those shares down 8.3% in pre-market trading, cutting its outlook for meat sales this year. Consumers are switching to cheaper foods as a result of inflation. So in order to say, okay, consumers can absorb higher costs, can they? Which items can they not? Which items do not have pricing power? Dish Network is down about 1.7% after missing estimates for earnings sales and showing subscriber losses. They also talk about a hack that made things a little bit more expensive and difficult. And I wonder how much cybersecurity is going to continue to play in this. And PacWest shares, Tom, surging 39%.
There you go, the percent move.
No,
Up to 8. I haven't done that. I'll do the math here to be responsible to our audiences in radio and TV. I'll do the resistance math here right now. I haven't done it yet.
But to me, I wonder, have we seen the worst of it? Is this a recovery enough,
No,
just
that's the
stability, to sort of have people move on? Or is this persistent feeling that something has changed? And it seems like that's what's still baked into the market.
I thought we'd found some stability about a month ago, so...
What do you know?
And then it hit the fan again. So I think we have to work through what we've described a million times as a process and not a one-off event. And Tom, you're going to have bumps along the way through that process.
What I mostly saw this weekend, guys, is a lack of research. It's a really important time to talk to Subrata Rajappa, head of U.S. rate strategy at SocGen, over the silence over the weekend off a shocking jobs report and maybe a reset of what interest rates will do as the thermometer of the system. Subrata, did you adjust? If I say to you, where's the 10-year yield 12 months out? Is this an adjustable number or is it one big SocGen guess?
No, I think we've kept our forecast relatively stable. We've seen sort of this up and down motion in the data week after week. On the one side you have the regional banking crisis, on the other side you have strong fundamentals. But if you look at the bond market, broadly speaking, from early March to now, really nothing has moved much. The 2-year has stayed around 4%, broadly speaking. The 10-year has stayed between 340 and 360. And the 2-10 curve has been anywhere around negative 55, negative 50 basis points. So it's been a lot of movement, but within a very, very narrow range because the market really lacks clear conviction on where we go from here. But that said, I think that risks continue to be skewed to the downside for yields. If we do get strong data, the market's going to dismiss it. If we do get weak data, I think you're going to see a little bit more of an outsized move lower in yields.
You went right where I want to go, Subrata. If I look at the Bloomberg Total Return Aggregate All-In Index, it's a price index, folks, and it's basically a straight line of, think Bill Gross, Mohamed El-Erian's success at PIMCO for 15 years. And then, as you know, Subrata, down 17% in the mother of all-in bond bear markets. And yes, there's been a bounce, but we don't talk about it like we talk about stock bounces. Are we bouncing off a bond bear market to something constructive?
Yeah, it certainly seems that way. Yields do seem like they peaked around 4% and 10s in the fourth quarter of last year, and the trajectory seems to be towards lower yields. I think that this time around, the key difference is that we might, Fed funds rate, nobody's expecting Fed funds rate to get back to the zero lower bound. And the decline in yields from here on is going to be much more modest and gradual. Even in our own forecast, we have 10-year yields only getting to 3.25% by the end of the year. Why? Because of the fact that you have global bond yields continuing to rise. The ECB is poised to hike more. The Bank of Japan could widen its YCC band at the June meeting. So in this sort of context, and inflation is also high and sticky, it's going to be very hard for a meaningful decline in yields from here on as well. So it's going to be one of those situations where yields remain range bound. We get perhaps very weak data. We price down to a lower range, but we're not going to go back to the zero lower bound in Fed funds. And 10-year yield decline is going to be a lot more gradual in that context.
Subhadra, what do people do when there's kind of this tight trading range and you don't really expect it to break out? I mean, do they basically just clock in for an hour, making sure nothing changes, and then go take a break? I'm serious. I'm just wondering how sort of sleepy things are out there as people realize that there is no conviction and there's very little visibility to get an edge on one side or another.
Well, you can trade the volatility within the range because you've seen pretty sharp moves in gamma. So you probably want to be long gamma in the volatility market and maybe pick up some returns there. But you're absolutely right. There are no larger directional moves to play in this market, given the fact that yields have been range bound, and people are positioning for the next leg lower in yields because that seems to be the broader directionality given tightening credit conditions. I mean, we know that policy works with long and variable lags, and the employment picture is going to remain relatively strong until the bottom falls off. So you're kind of positioning, if you will, for that sort of scenario where you see a meaningful slowdown in the second half, then you could see that next leg lower in yields. But again, as you were speaking earlier in your program, I think that the market is underpricing the risk of the Fed remaining on hold for the remainder of the year. We're pricing in cuts for the second half of the year. If we can get past the regional banking crisis, I don't see any reason for the Fed to jump into cutting rates in the second half.
What would it take to not be past the regional banking crisis? I mean, at a certain point, people are pricing in that it will persist. When do we signal the all clear?
That's a very, very difficult, question to answer because you're looking at an economy of haves and have-nots. The larger banks are doing, quite well. The smaller banks and the small business areas, if you will, are coming under a lot of pressure because of their dependencies to regional banks. So this sort of bifurcation is going to really muddy the picture. And in some respects, even though the Fed continues to say that the financial stability concerns, they have tools to deal with that, they have tools to deal with inflation, these two opposing factors are going to make it very, very difficult for the Fed to really adjust policy in a meaningful way. They can't cut rates for financial stability and they can't hike rates for inflation. So that's when policy gets very tricky. They're probably going to be on hold for the remainder of the year.
Subhadra, never mind the Fed. We've got to talk about the ECB. Eric Nielsen, UniCredit, fantastic note over the weekend, said this: "My fear is that as the lagged effects of the monetary policy tightening now begin to hit the economies, the European underperformance will be longer, deeper than needed because of excessive monetary tightening." Subhadra, industrial production in Germany this morning, downside surprise. Factory orders last week, ugly. Earnings from Maersk don't really scream that trade is good right now. Subhadra, do you think there's a real risk here that perhaps the ECB, relative to the Fed, is the central bank most at risk of making a policy mistake at the moment?
Well, that is always a problem when you're following the Fed and not leading the Fed in an inflationary environment or in a hiking environment, broadly speaking. This almost always happens in every cycle where the ECB, overshoots or delivers more hikes because they're singularly focused on inflation, but not broader economic fundamentals, and then they have to play catch up on the downside to the U.S. I mean, broadly speaking, if anything, coming into this year, I think a lot of people are expecting the European economy to go into a recession. The European economies and UK even has done a lot better than people had broadly expected. That said, a slowdown is to be expected given how aggressively the ECB has hiked rates. So, the trajectory, I think, ultimately will be that the Fed will have to pivot and the ECB will have to pivot shortly thereafter.
Subhadra, wonderful to get your perspective, as always. Subhadra Rajappa there of SocGen on the latest on the Fed and the ECB. That note from Eric Nielsen over the weekend, Lisa, great read. The risk that the ECB is going to excessively deliver excessive monetary tightening relative to the data that we're starting to see in spots. I don't want to overdo it here, but in spots over the last week show some weakness.
I feel like this is the same conversation we were having 6 months ago for the Fed, right? That basically they were overdoing it and they were raising rates too far at a time when there were signs of weakness, and those signs of weakness never really materialized in the way that a lot of people thought. So it's a very difficult moment because if you do believe that Europe is tracking the U.S. on a lag, well, this is exactly the narrative in the U.S. about 6 months ago.
I think it's one of the most misunderstood things. If you take the animal spirit, the nominal GDP of the United States of America, and you go back, John, to the financial crisis, guess what? Before that, Eurozone was really advancing nicely. There was a real log slope. It ended in 2008. Is it eurosclerosis? It's not for me to say. We'll listen to our guests on that. But I'm sorry, they are radically two different trend lines.
Perhaps, and we don't know yet whether this is really the start of something new. One thing that's notable is that the dollar has underperformed in light of the small banks and what's going on there. And that's like one of the distinguishing features right now between the U.S. and Europe.
The Eurozone Bank Lending Survey last week was pretty ugly.
It was.
I'd say, yeah. And they still hiked interest rates and signalled they'd go again at the ECB, Tom.
John, 110.47.
I know. It's a total snooze. It really just hasn't done much. 110.46 right now from New York City. Taking the rest of the week off. I'm Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there's no good alternative to Congress lifting the debt cap. She also told ABC that the use of the 14th Amendment would spark a constitutional crisis. President Biden is scheduled to meet with House Speaker Kevin McCarthy and other congressional leaders tomorrow to discuss the debt ceiling. A new poll shows President Biden's approval rating hitting a career low. It shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44-38. Russia reportedly has at least 300,000 troops inside of Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. In Germany, industrial production fell by the most in a year. That raised the risk of Europe's largest economy slipped into a winter recession. Output dropped 3.4% in March, more than twice the decline that economists had predicted. The decrease was especially pronounced in the automotive sector. And in Saudi Arabia, the economy expanded at a slower pace in the first quarter of 2023, and that was due to the oil sector, which grew at its lowest rate in more than a year. Saudi GDP rose an annual 3.9% in the first 3 months. That compares with 5.5% in the previous quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Is the Fed's job to help the banking system right now? I would say, this idea that they can separate monetary policy from financial stability, I actually highly disagree with that. The way monetary policy works into the economy is through the banking system. So some of this tightening is the intended consequence of tightening. This is now for the private sector and for the government to figure out what happens with the regional banks.
That was Priya Misra of TD. Phenomenal, as always. A bit of stability this morning. Looking at PacWest and a pre-market trading much, much higher off the lows we saw last week. It was a $10 name last Monday, dropped aggressively. It's basically an $8 name right now in the pre-market. We'll stay on top of that for you. Outside of that, in the equity market more broadly, on the S&P 500, positive by 0.2%. Going into CPI later this week. That's on Wednesday. Got a ton of Fed speak as well in between through the data points this week. Yields higher at the front end. We're up 6 basis points on a 2-year rather, close to 4%, 3.98, let's call it, on a 10-year, Tom, at 4 basis points to about 3.48.
John, one of the things we want to do is get qualified people to talk to, and we're going to do that right now. The story is extraordinary. Jelena McWilliams is a former FDIC chair, yes, a Kravis, Swain and more, but far more than that, she's enjoyed the failure of deposit insurance. Her father was flattened in Yugoslavia years and years ago over a failure of a bank. She wandered into Berkeley, sterling academic career, including service in the law business in Palo Alto, California. There's no one more qualified to talk about this banking mess than the former FDIC chair. Jelena, thank you so much for joining us this morning. Let me cut to the chase right now. Does this crisis have staying power, or are we solving idiosyncratic tech banking problems?
I would say, and thank you, by the way, for having me this morning. I would say that we're at the place where this crisis should not have had staying power. And yet here we are about 5-6 weeks in. And I'm hoping that we're at the tail end of that. The government does have a number of tools they need to use, and I'm happy to chat with you about what those tools are. But the problems are not so much idiosyncratic as much as at this point we have created a crisis of confidence in the banking system, and that's where we are.
How does real estate fold into this? Many will say, okay, it's not going to be the drama we've seen over the last number of weeks, but commercial real estate. What do you observe there?
A lot of the banks have actually, especially regional banks, have high concentrations and exposure to commercial real estate. In good times, they're generally able to navigate the concentrations in their portfolio very well. But again, we're at the point where there's so much volatility in the marketplace with the market expectations of the banks. And frankly, the empty offices in a number of commercial markets in the United States are not going to help that.
Jelena, should these banks be in that business? I mean, this is sort of one of the questions at a time where we're seeing the number of smaller and regional banks shrink dramatically over the past few years. Should it be their business to provide a majority of the commercial industrial loans and a majority of the commercial real estate lending?
You know, I think this goes back to the intrinsic question of the tiered banking system in the United States. You have different levels of banks and different sizes. So one of them, you know, you have community banks. They're generally banks below $10 billion in asset. You have mid-sized banks above that, and I would say below $100 billion. Then you get into the regional land, and that regional land is about $100 billion to as high as like $500 billion. Above that, you get into the very large banks. And the truth of the matter is that if those banks, the regional banks and mid-sized banks and community banks are not financing local real estate, commercial real estate transactions, they won't get financed. The role of these banks in the U.S. economy is so high that people actually, frankly, underestimate what these banks mean for our financial ecosystem. So should they be in it? Should they not be in it? It's almost irrelevant. They are in it. They need to manage the risk in their portfolios. And with the rising interest rate environment, it's going to be incredibly difficult for them. And frankly, the pandemic didn't help with people not wanting to come back to offices. And you have tens of thousands of square feet of commercial real estate, even in some of the most prime locations, sitting empty. You know, I was just in San Francisco a couple of weeks ago, and it's a ghost town.
Well, as a former regulator yourself, should there also be the same kind of regulatory scrutiny and requirements at some of these regional banks as there are at larger banks?
No, actually, absolutely not. And here's why. Our regulatory system needs to account for different tiers and different, I would say, strata in our banking sector. These banks present different types of risks than the G-SIBs, the global systemically important banks. They present different type of risk than mid-sized banks. And the job of the regulators is basically to accommodate that risk. The job of the bank is to manage that risk. The bottom line is when the bank fails to manage that risk, you get into in a situation that we have been in the past few weeks. But it's not, as much a blame as we can put on the banks and the bank risk management in some of the failed bank situations. I think there is a portion of blame that goes on the U.S. government.
I just looked at the bank assessment rates at the FDIC and my eyes glazed over, Ms. McWilliams. I mean, it's complex to say the least. How much does J.P. Morgan or Bank of America pay each year for FDIC insurance? Do you have a number?
Well, there is a number. You can go to the FDIC. I don't want to single out a bank. It's a lot of money. It is a lot of money. There are two different sets of formulas. There is a complex bank formula. There is a less complex or a small bank formula. Go ahead. I'm sorry.
I don't mean to interrupt, but I am. Senator Warren would say raise the rate on James Dimon and Brian Moynihan. Is there wiggle room here for the big guys to pay more FDI insurance to take the load off the back of Andrew Jackson's 4,000 banks?
So it is very possible that the FDIC may just come out in that direction with the special assessment they need to impose to make the deposit insurance fund whole. As you know, some of the banks that have failed and have been subsequently sold have created a deficit for the deposit insurance fund. And as a result of that, there is going to be a special assessment, and I believe that's where the FDIC is heading.
Yelena, are you concerned about the Federal Reserve in its role as regulator? Do you put the blame there? It seems like everyone's just basically quietly blaming Randy Quarles and then leaving it at that. But do you think that this is something endemic in the oversight and the enforcement role that the Fed often plays?
Quite frankly, to blame prior, vice chairman for supervision for something that has happened about a year and a half after he left office is a little bit preposterous. But I do think, as a former Federal Reserve staffer, I was there during 2007, 8, 9, 10 crisis. I will tell you this, they're good people working at the Fed. They have a lot of mandates they have to satisfy. But we are at a place that is about financial stability. And the whole debate about monetary policy and financial stability, we're at the place, if these banks are not stabilized, we are not going to have financial stability. And so to the extent the Federal Reserve takes its financial stability mandate seriously, I think it's long overdue that they take a look at the banking situation in the United States and what the interest rate rises have done to the banking sector as they contemplate where to keep the interest rates.
Yelena, thank you for weighing in on all of this. Thank you. Yelena McWilliams there on the latest in the banking sector. Here's the latest right now. Luca Maestri over at Apple making a move. The CFO. They're kicking off a 5-part corporate bond deal. Tom, need some detail here on maturities and overall size. But if you go back to last summer, last August, they came out, I think, with a $5.5 billion bond issue, 4-part sale, $23 billion order book. So you can imagine what the order book might look like, Tom, for this one.
I mean, what they have earnings Thursday? Was it? We mentioned this. Everybody's doing this. They're coming out with bond offerings, even if they don't need the money. And they waited 2 business days till they come out with it. Right now, weight of debt at Apple, 4.1%, which is absurdly low. Their cost of debt is 3.3%. The weighted average cost is 0.1% versus the equity, which is 9.7%. Do they need to do this? Clearly no. What are they going to do with the money?
Buy back shares?
I guess that's where we're going.
What they used the last bond issue last summer for.
And the maturities, Lisa, 2026, 28, 30, 33, and 53. And I'm going to call it the red herring, the bond. I don't know if the bond prospectus is a red herring, but they're the maturities right now. If you want to bring that up on the screen, guys, that's really important to go out to 2053. It's not like my Austrian piece, but there it is.
Well, these typically are longer duration bonds, and we have seen that from the Apples of the world to the Microsoft when they sell one of these benchmark massive sales. They often are more heavily weighted to the long end Is there a sign that they're trying to get ahead of more rate increases, or do you think that this is just simply creating liquidity in the market for their other shares, for their other bonds? I mean, I don't understand why they would need more cash because they have basically the size of the German economy.
I just all weekend, the death of Apple, the death of tech, it's all overvalued. And that, at Cupertino, I don't think they got the memo.
Expected to price today.
Yeah, it's like three phone calls.
Traditionally, he's a good market timer.
Exactly.
Let's put it that way.
They
Traditionally, he's a very good market timer.
Anyway, we have Rob Waldner coming up, right?
We do, yeah.
Perfect. Absolutely perfect given this news.
Rob Waldner of Invesco. The latest headline, Apple debt offering in 5 parts. It's expected to price today. Rob Waldner of Invesco is joining us shortly from New York. This is Bloomberg.
This is still a very robust economy, so the tightening is yet to show up.
This is the Godot recession. We're still waiting for it.
The Fed's not going to quit until the labor market quits.
We've had this temper tantrum against the Fed and using bank stocks as a weapon against the Fed to try to get the Fed to change.
It's not up to the Fed to solve the banking problem. They did what they could do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. A Monday to get our heads screwed on straight. Many stories here. John Ferro focused on the senior loan officer survey. They're not going to mention Apple in that survey, are they?
Me and everyone else. I doubt it, Tom. 2 p.m. Eastern Time is when that drops. This is about bank lending standards. They were tightening going into the financial stress of the last couple of months. Are they continuing to tighten, Tom? Enough so that it takes some of the jobs, some of the work away from this Federal Reserve who are looking to get inflation lower.
Certainly we've heard from guests this morning that is the reality and that we're going to see a different bank. To me, and the key word I heard was scale, that we heard from Michael Purvis, I believe it was. The idea here of smaller institutions, less efficient institutions, and what do? You get tighter on lending. It's a serious issue for a huge body of America.
With the Federal Reserve seemingly on pause, and I say seemingly, that's the view of a lot of people. It seems to be implied by the dot plot from the Fed last time around in their projections, but ultimately, is good news good news? And on Friday it was off the back of payrolls data. Can we enjoy robust output data without the fear of this Fed spoiling it all, Tom, and hiking interest rates?
These are some of the battles, and of course, again, it's a timeline moving out. We had a comment from Mr. Bullard of St. Louis earlier where he's looking at the x-axis and it's farther out there. Lisa, your thoughts over a weekend of reading and just thinking about how the x-axis has changed off the bombshell report we saw.
We've been talking about the Senior Loan Officer Opinion Survey and how important it's going to be, and I expect that after 2 p.m., everyone's going to come out and try to discount it one way or another as being lagging and just reflecting the tighter credit conditions from higher rates. And this is exactly what Andrew Hollenhorst just put out from Citigroup, saying that, it's very difficult to tease out what is something that's inappropriate versus the intended design of Fed tightening. And so then how do you use this then to understand anything, let alone justify not raising rates in the face of relatively hot data still?
The 3.95% coupon out 2052, I should say, not 1952. Off the October bottom, John, the Apple piece is up 13% for an annualized 25% return on that long bond. Apple's going to make profit total return for people again.
So we've got a 5-part bond deal debt offering that prices today from Apple. Is this a real test of the debt market in the United States?
No.
We had LVMH out in the last month as well in Europe. These are high-quality companies, Tom. Very desirable, fantastic earnings, cash machines, if you will, with fat margins that are likely to produce big order books to suck up a lot of this debt.
The wheelhouse long ago, folks, one day, a brilliant woman from the University of Chicago walked onto the Bloomberg news floor, and they said, bonds. Lisa, this is your wheelhouse. I mean, literally, 4 phone calls are made?
They actually are probably pushing people away. There probably are many more people who want to buy this than they have bonds
That's
to
called
sell.
oversubscribed.
Correct. So it's a question of the allocation fight that you get, and it's going to be like a food fight for this, especially given the lack of debt that's been sold so far this year. To your point, is this a test of markets? And from Apple's point of view, is this a statement of the market condition right now, especially after earnings that came in better than expected?
And the ultimate responsibility of a CFO to look at capital allocation, John, they have 4% debt. which V. Bodie up at Boston University would say, that's not efficient.
I'm still thinking of Bramo, her first day walking into the office. Why are you all so happy? Why are you so happy?
More or less true.
Let me tell you why you shouldn't be happy.
My first day at the office, I'm sitting there and there's all these worthies around me. And they think I'm a journalist, fooled them. And I'm looking around and I'm going, Felix, Pulitzer Prize? Oh, William Ahern, ran Associated Press. The worthies I was surrounded by. Yeah. I was completely out of my element.
Very cool, Tom. Yeah. Very cool. Pushing ahead to the rest of the week then.
Data.
CPI coming up on Wednesday. Lots of data. PPI the day after. Tom mentioned slews. I hate that phrase, slews. I don't like calling it slews. Senior Loan Officer Opinion Survey coming up a little bit later. Neither do I.
Yeah, I can't.
2 p.m. Eastern Time. That's coming up. Looking out for that with the equity market right now on the S&P 500, just about positive, up by 0.2%, Tom.
Very quickly, we've got a wonderful guest. Gold 2030 has the attention of people like Christopher Verone. He's enthusiastic on gold. We get beyond lucky. He was previously scheduled to talk about the boring bond market. Rob Waldner joins us, chief fixed income strategist, head of macro research at Invesco. Rob, I'm going to rip up the script and I'm going to keep you out of your compliance office because you can't talk about individual names, so we're not going there. But when a big company comes out with an offering, 5-part, 6-part, or whatever, is it the stereotype, the cliche? They call Fidelity, they call Invesco, they call PIMCO, and the whole deal's done?
Well, Tom, I think that this is going to be very well received by the market because if you look, we have seen, quite a lot of demand for high quality fixed income, and I think the value proposition is quite good because we have, positive real yields. We have spreads, which put the average of the investment grade market at about 5% in total yield. Apple will come inside that, but we've had tremendous demand, and actually, there's more demand for industrials than there are financials. We've had a lot of financial issuance. Financials are wider, while industrials remain quite well supported. So, I expect a deal from a high quality issuer would be very well received.
I look, Rob, at where we are. And it's simple. Do you buy them for maturity? Are you buying them for a trade?
Well, I think if you're a medium-term investor, you can buy these to earn, somewhere close to 5%, probably a little bit below 5% over a multi-year period. I think that would be where a 10-year would come. That's pretty good for getting that level of income in a very safe asset that is likely well protected, even if we get some sort of economic, slowdown or recession. Seems like a good investment from a medium-term perspective.
Rob, away from Apple's pricing, can we talk about what it might signal? Larry McDonald has talked a lot about this. Brings up the timing of Luca Maestri over at Apple, who just seems to time this debt market phenomenally well. And what often happens if you plot it on a chart is that they come out with the bond issue and soon thereafter, you'll start to pop higher again, Rob. Now, I'm just wondering for someone like you, if you pay attention to things like that.
Well, John, I think that very well may happen here because we have this bond market in a very interesting place, right, where the yield curve is steeply inverted. So from a bond geek perspective, that means that you get negative, the further out the curve you go, kind of the less you're paying. And so if they can kind of feather in some of these longer maturities, we do think we're probably in a range. And we're probably closer to the bottom of the range with this market that is caught between disinflationary slow growth and a very aggressive Fed. So there's room for the market to move back up. And so in the short term, this may prove, a good place for them to do issue.
Does it make sense to you for them to raise money at all at a time when money actually costs something, given that they have a cash pile the size of a pretty big economy on their balance sheets?
Well, I can't speak to their capital allocation. I don't have much information there, but it would make sense as part of a medium-term strategy to manage your liabilities. I would have thought to continue to be active in the market.
Given the fact that there hasn't been that much debt issuance, can you talk a little bit about the food fight that would emerge over allocations in this type of deal? How much the paper might trade a lot tighter than people would otherwise expect. The deal that Apple gets will be much better than people expect simply because there has not been that much supply.
I think it comes back, Lisa, to what I was saying, which is if you're a medium-term investor, there's really quite a lot of opportunity here to lock in what seem like pretty good returns. And I think this is for the broad IG market overall, not just for an individual issuer. But, if you think you're going to get something close to 5% for 10 years, which is where the IG market is, and those are high-quality issuers. So whether we have recession, whether we have, whatever those, you should be relatively well protected from default. That's a pretty compelling value proposition, and I would expect there to be quite a bit of demand. As you point out, you can have oversubscriptions and the issuer tightening these things in as they talk the book up. But we'll have to see how that pans out.
Rob, last Monday we had an ISM manufacturing prices paid component push yields about a bit, but on the same day a ton of IG issuance as well pushed yields higher. I understand from our team here at Bloomberg, Michael Gumbel leading our reporting, that we'll have 15 borrowers tapping the investment grade market today, 5 billion coming from Apple potentially. Rob, does that have the potential in size to push around the Treasury market a little bit through this session, through today?
Certainly a large amount of issuance can push things higher. I think what's also important is how much demand that we get. Overseas demand has been very important to the market. And so I think that the medium term, it's all going to be about the macro fundamentals. Short term, it can be knocked around by issuance or supply demand issues, but medium term, it's all going to be about the macro fundamentals.
Rob, we got to make some news here. Do you get a call from Luca today? I mean, when there's a deal like this, does he dial 1-800-INVESTCO? You pick up the phone and, you go, how things going? I mean, help me here.
Well, I think, Tom, we have a, very solid corporate trading desk, constantly connected to all these issuers. And they do a great job, and I'll leave that to them.
There's some media training for you, TK, right there.
We've got Atlanta Braves tickets. Come on down.
Rob Waldner of Invesco. Rob, thank you, buddy. Thank you very much. I don't think Luca needs to call anyone.
No.
Yeah. I think they're all sort of like...
Yeah.
Well, to your point, John, you were great on it. LVMH was a feeding frenzy.
Yeah.
And why is this any different?
You'd expect a high-quality company with fat margins to come to the debt market and do exactly what it wants to do. They don't have to beg anyone.
Back in 2013, there was an investigation over the allocation process because a lot of the smaller investors felt like they weren't given a fair shake from some of the syndication desks in order to have an opportunity to buy the debt. So, it's that kind of deal.
Coming up shortly, about 8:30, 20 minutes from now, we'll catch up with Dilip Singh of PGIM Fixed Income. Used to work for this administration, so really interesting conversation potentially around the debt ceiling. Look out for that in about 20 minutes' time. From New York City with your equity market higher by 0.2%. On a beautiful Monday morning in New York. Did you feel spring, Tom?
Yes,
turning slowly into summer over the weekend.
Yes.
Beautiful feeling. Remember the sun hits your skin, that warmth, Bramo, makes you smile.
Summer for a day.
You know when you feel
and
happy.
And then we get winter again.
You know when you feel happy.
No, I don't know. I'm not familiar with that.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says there are no good options for solving the debt limit stalemate other than Congress lifting the cap. Yellen told ABC that the White House resorting to the 14th Amendment would provoke a constitutional crisis. President Biden discusses the matter with congressional leaders on Tuesday. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. Now, the 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest, which was jammed with ammunition. It's a holiday in the UK following the weekend coronation of King Charles III. The crowning ended Charles's 7-decade wait for the throne, and it marked a turning point for the UK and the monarchy as it tries to adapt the current era of technological and social change. The king told a packed Westminster Abbey that he had come, quote, not to be served, but to serve. And President Biden will announce that the government is drafting new rules on airline benefits for stranded passengers. Carriers could be required to provide meals, hotels, and additional compensation due to canceled or severely delayed flights. Authorities say they expect air travel this summer to surpass pre-pandemic levels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
banks fail every single year. Right? It's just not usually the 16th largest bank by assets. And that's what really caught people's attention. And so, I think we could see continued stress in the banking system broadly, but very much at the lower end as we work through some of these COVID excesses and we work through the duration mismatch that we know exists today. I'm not sure that we're out of the woods, but I do think that the big booms have probably been heard.
Fantastic from David Leibovitz, the global market strategist at JP Morgan Asset Management, starting a new week without much sign of stress at the moment, on the surface at least, and some of those banking names we watched throughout the whole of last week, PacWest being one of them, slashed their dividend, said business was sound still. Their stock is rallying in the pre-market. Elsewhere in the bond market, a lift in this whole curve now, 2s out to 30s. Your 2-year is higher by close to 8 basis points in the Treasury market. Your 10 years up by almost 6, getting closer to 350. We learned a little bit earlier on this morning that we'll get some bond issuance later from Apple, a $5 billion offering, Tom, across 5 parts. We'll have 15 borrowers coming to the US investment grade market today. So that's kicking around the Treasury market just a little bit potentially through the session today.
Constructive. And John, note oil from 70 and the worry of 69 a barrel. West Texas Intermediate 73.31. Even they're cooperating a little bit. I mentioned gold earlier, up $6, 2,000 at 31. One of the things we realize is the small banks of America are not going to be salvaged by Fort Knox and gold holdings. Herman Chan is expert at this. Herman knows that there is no gold at PacWest or the others. And yet, off of the Friday Joy, they have a, quote, fundamentally sound relationship banking model. Mm-hmm. Is it a smaller model? Is everyone going to be downsizing into 2024?
I think you'll have a more conservative balance sheet across the board for regional banks, less interest rate risk. Less interest in putting riskier loans on the balance sheet just because you don't know what's going to happen over the course of the year.
So then which ratio do you follow? I mean, if there's less growthiness, including tech idiocy like 1% mortgages and, the marketing game that we saw that was a disaster outside San Francisco, fine, move on from that to the new model. Is it going to be where high single digit, even dare I say double digit bank returns become mid-single digit? Is that the shift you have to make?
I think you're going to have to make an expectation that banks aren't going to really grow their balance sheet this year because of the deposit issue with deposits flowing out of regional bank balance sheets. That means there's just less ability for banks to lend, and they're going to be less impactful in terms of having the appetite to lend just because there's a recession potentially coming down the corner, and you really want to be careful in terms of what risk you add to your balance sheet. You don't want to compound the problem of the interest rate risk with credit risk.
2 p.m. Eastern Time, Senior Loan Officer Opinion Survey, much anticipated. What don't we know already that we're looking for from that survey later on this afternoon?
We just want to confirm in terms of how much pullback the banks are doing in terms of their appetite for lending. So that's the biggest takeaway that we're expecting coming in at 2 o'clock later this afternoon.
Will it matter, or will it just be so backward looking that people will discount it?
I think it will matter because it'll be a confirmation of what banks have talked about in the first quarter earnings call. We have heard some regional banks talk about narrowing the credit box a little bit on the margins, not being as aggressive in certain areas like auto lending, leverage lending. So areas of lending that don't offer the best risk-adjusted returns. And so we're looking for more confirmation of that in the Senior Loan Officer Survey.
We were just speaking with Jelena McWilliams, formerly of the FDIC, and she said that, there is some concern that there wasn't accurate stress testing of just how high, and I'm butchering the way that she said this to some degree, just to be completely fair, but there is a question around whether there has been recognition of what higher interest rates and the speed in which they were raised will do to the banking model of the regional banks. Do you think that we have our head wrapped around that yet, or do you think that still is a mystery to a lot of people on Wall Street?
Yeah, so I think of banks like a Goldilocks industry. You don't want to be too hot, you don't want to be too cold, and with the economy being too hot last year and interest rates rising as fast as they did, things tend to have an opportunity to break, and we saw that with SVB and with First Republic. So I think now there's more of an appreciation of the risk that banks have on their balance sheet. And I think the entire industry, the analysts, the investors, the regulators now are more attuned to the risk on banks' balance sheets.
I have never read the sluice. Did I do okay there?
That's beautiful.
And I noticed, like with 18 paragraphs, there's 11 footnotes. Right. Herman Chan reads all the footnotes and everything. If we know those guys in Washington have knowledge about these banks that we don't have, do you get that knowledge in the sluice?
You get There's more data in the sluice in terms in terms of the idiosyncrasies to what is really driving the demand and supply of lending.
Tom jokes, but do you know how many people will open the Senior Loan Officer Opinion Survey for the first time later on this afternoon? It will be the first time for many people.
Exactly.
A lot of people in the Treasury market, a lot of people more broadly, economists do look at these things, but I think this is the first time in a long, long time that I can think of that this has become a key focal point. When you open that later, what's the first thing that you and the team will look for?
We're just going to look for what the survey says in terms of loan supply. Are banks pulling back on credit availability, and what's driving that pullback? Is it going to be concern about the economy? Is it concern about credit? Is it other competitors pulling back as well? So all of these things are important as we look ahead for the sluice.
Is the demand component to it interesting to you?
The demand component is as well. So there's a little bit of both in the sluice. So you get a flavor in terms of really both sides.
Are you expecting that the loan book will come down simply because companies are not borrowing, companies are not investing, that there's been a lack of confidence in the C-suite that possibly exceeds the lack of confidence that we've seen from consumers?
I think so. You're seeing commercial loans and commercial real estate loans in particular pull back a bit. And so that's just the expectation for banks in general for the regionals that we cover, is that there's just less demand. A couple of regional banks have talked about less capital spending. So that all feeds into the demand component as well.
Herman, this was great. It always is. Thank you, sir. Herman Chan there of Bloomberg Intelligence, looking at PacWest in the pre-market. 775. It was 10 last Monday. I can tell you through last week, it just got absolutely hammered. The low of last week, 248. Thursday, Tom, intraday, 248 on PacWest last week. It started the week as a double-digit name.
Yeah, it's huge gyrations, and I think there's a real mystery out there. And again, I go to this word of the morning, which was scale. They're losing scale. How do you do better losing scale? Show me an industry where that works out.
And what's the playbook going forward for some of the banks as they start to need capital? Over the weekend, there was a story about how the government is trying to rearrange their loan loss sharing agreements to possibly allow for private equity to come in and involve themselves more aggressively for the bidding. And the argument here is to bring down the pricing so that they get a better deal, right? So that the government loses less money. So far, they've required bank charters to really participate in this, which left JP Morgan and some of the biggest regionals as the only players in town. Now they want the KKRs, Apollos, et cetera. I'm just, giving the names of some big private equity firms, but to possibly come in and play in a more robust way. How much does that change the field?
A greater financialization. That's really what it amounts to, a whole set of new players.
I saw someone say this week, and it's attached to this conversation, that they'll have confidence in the system once you start to see private sector solutions without federal backstops. That once you start to see that, they'll feel more confident about the situation. Yeah. I don't think we're going to see that anytime soon based on the template that was delivered by First Republic and JP Morgan, because there'll be some people that just look at stress and say, there are benefits to waiting.
Especially given the fact that they have assets that are fundamentally challenged, that if they liquidate, they can't meet their obligations. It's a huge issue. It's just an insolvency issue that really creates a problem for the FDIC.
A lot of people are saying they're not near the liquidation part, but then you don't know which single banks are out there. Michael McKee emailing in saying, Tom, do the work. So I did the research on the sluice. I did a word search off of Fed minutes, and we looked at some, several, a few. None of that verbiage is in the sluice. The sluice is different than the Fed minutes.
It's not the participants.
The only thing they have similar is I've never read either of them.
I believe that. Coming up, allow me to promo another property of mine.
Before you leave.
Bloomberg TV with a cheesy smile. Very American TV, that is,
It is.
Look down the barrel of the camera.
It's coronation free today?
Need to get my teeth whitened or something, Kathy Jones at Charles Schwab, Brian Levitt of Investco, Stuart Kaiser at
Stuart
Citi.
Kaiser, good.
Hey, all the jokes about British teeth. Give me a break.
Okay.
Come on.
Fair.
Come
Fine,
on.
go ahead.
Come on. From New York. Good morning.
Bloomberg Surveillance, and good morning to you. Lisa Abramowicz and Tom Keene. John Ferro preparing for the next hour as he chooses to do. Futures up 10, and the VIX well under 18 right now after the gyrations on Friday, 17.46. Lisa, I'm going to look at a substantial move in the two-year yield, buttressed right up against 4%, 3.98%. That gets my attention.
A lot of people were wondering why we didn't even see a greater move in the two-year yield last week, just simply because we got hotter than expected inflation reads and that labor market report. What was the 14th consecutive month that we got a non-farm payrolls report that exceeded expectations?
And I was doing the work in real time there at 8:30. Jason Furman did better work up at Harvard doing Act 10, where he took the quarterly 3-month average, which I think is a nice way of doing it. And the answer is we talked to Krosner about, it just goes out at 245,000, 265,000 per month. That has to break, and it hasn't broken yet.
And there's been a slow drip, but not fast enough to get people some confidence. We are seeing some stability around all of the asset classes. What I find interesting is that the dollar, more days than not, has lost, right? We have seen a weakening in the dollar, even though we haven't necessarily seen a huge fall off in the economic data. Good news was good news for equities, but the dollar still faces some headwinds as people wonder whether perhaps we saw the peak earlier.
This is just out. I wouldn't even have time to discuss it now with our good guests, but Robert Schiffman, who's really good at Bloomberg Intelligence, he asked the money question of the day. If Apple has so much cash, why borrow even more? ? We'll try to bring that to you here in the next 30 minutes. Apple, with the rating now, why don't they have a AAA rating? I mean, I don't know. Maybe it costs too much. That used to be the crux years ago, but it's a AA plus rating.
Why should the U.S. have a AAA if they're about to default? I mean, you could say that Apple in some ways
that. Nice
is. Well, I mean, this is really a big question, right? What's in a credit rating and how important is it to maintain that, and what's required to do so at a time when it is so rare, even for a behemoth, again, with a cash pile the size of a pretty big economy?
Let's get smart on this right now. Dalip Singh joins us, chief global economist at PGIM Fixed Income, with serious experience recently in the White House. Dalip, in the office, is it tomorrow? They're going to have a meeting, a confab on the debt. It's all politics, isn't it?
Morning, Tom. Morning, Lisa. Look, talking is always better than not talking, but I'd be surprised if we get a decisive breakthrough tomorrow. The incentives are just not yet in place. McCarthy could lose his speakership if he folds early to the president with a clean increase in the debt limit. The president can't give a nod to anything near the scale of spending cuts proposed by McCarthy because they would undercut much of his domestic agenda and lose his political base. So I'm afraid market stress is still what's needed to create cover for face-saving compromise. And that's why, perversely, market complacency is self-defeating.
You and Gene Sperling have been very good at this, of trying to link this policy dynamic into Wall Street. As Lisa mentioned earlier, Wall Street seems soundly removed from this discussion, this debate. Are they correct on that, to be removed, to not worry about this debt crisis?
You know, look, it's muscle memory. And that muscle memory is dangerous because the context has changed pretty dramatically from the last time we had a serious flirtation with default back in 2011. For one, Congress is as polarized as it's been in our country's history. Second, you know, we are trying to roll over a debt stock that's twice as large as it was in 2011. 3, foreign holdings of treasuries are up to $7 trillion. That's almost $3 trillion higher than what we had in 2011. 4, back in 2011, Europe was in an existential debt crisis. China had yet to lure serious inflows from abroad. Digital assets had yet to go mainstream. There were no alternatives to dollars. That's changed. And lastly, and I think most importantly, we're currently the U.S. spearheading the most severe economic sanctions campaign against a G20 country in financial history. That creates incentives, geopolitical incentives, for countries to hedge. The debt ceiling just needlessly adds impetus to those incentives at a time of geopolitical peril.
Why do you think, Dalip, from your vantage point of having worked at the White House, of having worked at the Treasury, of having worked at the Fed, all of these different agencies, why do you think things have gotten so dysfunctional in Washington, D.C.?
Yeah, I mean, the debt ceiling really is just symptomatic of that polarization, Lisa. I mean, I think it's derivative of the atomization of the media, extreme levels of inequality, and technology that allows political movements to gain scale at speeds that we haven't seen before. And look, now we're on the cusp of doing something that great powers just don't do. They don't default. They don't talk about default. They don't think about default. And your measure of greatness is when no country questions whether you would ever do so.
So
it's brought us to this point.
Some people would say, Dalip, that there already are economic consequences to even having this discussion in such real time. And given the fact that it does have a different kind of more polarized nature to it, what are the longer term impacts, even if there is a solution that is found at the last minute when the market finally wakes up and applies the real pressure that Washington's waiting for?
Lisa, dollar primacy is a national treasure. It allows us to fund our government at 20 to 50 basis points cheaper than it otherwise would. That adds up to real money, $150 billion for every 50 basis points on treasury yields. It allows us to absorb a shock, like the 2011 downgrade of our credit rating, and it allows us to deliver a shock. All of that is being put at risk in terms of the long-term scarring effects of this type of debate. Just remember, dollar primacy is nothing more than a network, okay? It's rooted in trust and inertia and an assumed lack of alternatives. But every network, whether it's in biology or ecology or in finance, they have tipping points. They're usually psychological tipping points that you can't see in advance. And we're now pushing ourselves towards what I would consider to be a very dangerous place the closer we get to the X date. So this is very serious. A lot is at stake.
Well, this is actually a really important point that a lot of people argue against, saying that the loss of the dollar's supremacy as the global currency has been overstated. The death of the dollar has been perhaps overwrought. However, other people like yourself saying, actually, it's becoming much more real. What are you looking for in the data to show that that is actually what is transpiring, that people are moving away from the dollar as the main dominant currency of exchange?
You're not going to see it on paper. I mean, the measure of primacy is really, do you use the dollar to buy or sell stuff? Do you use it to borrow money? And do you use it to price transactions? And on paper, there's nothing to see here. This is a tail risk, but we're gambling with an exorbitant privilege that has incalculable benefits. And so it's the kind of tail risk that you should never take. That's the point.
I looked, Dalip, at this, and it's a history which you studied at Carolina and also up at MIT. The ageless history of our debt caution, I'm going to call it our almost debt religiosity. What do the people where they say, we got to get rid of the debt, it's just like Apple's corporate debt. Heilbronner and others wrote a book 40 years ago saying, no, it's not. How do you respond to people that viscerally feel this government debt is bad?
Yeah, this is a legitimate question, Tom. I don't think we're in a crisis, however. So long as our nominal GDP growth is higher than the average interest we pay, the math of debt sustainability improves over time. And right now, that's the case. Our nominal GDP growth year over year is about 7%. It's actually been in the double digits for much of the past 2 years. The weighted average interest rate in our public debt is 2.6%. Now, for that to be sustained, of course, the market has to believe the money we're borrowing will be put to productive use. That's the key question. And I think, look, that argues for the kind of investments that the public sector is making where the private sector is underinvested. R&D, infrastructure, technology, programs that grow a workforce, make them more productive. That's really the measure of whether the debt that we're borrowing is going to raise our nominal GDP growth to levels that can sustain a rising interest rate cost.
And with that beautiful explanation, good enough for Olivier Blanchard or Joseph Stiglitz, if they've studied this as well, wrapped around our start and the rest, the trust mechanism is that government will put it into good projects. Can't that be discussed tomorrow among a fractured polity in Washington?
It can, but not with a gun to our head. The consequence of not reaching agreement can't be we're going to burn the house down. We absolutely should have a discussion about spending and revenue levels. How are we going to use our resources to solve structural problems that the private sector won't solve by itself? Extreme inequality, social disparity, vulnerabilities in our supply chains, the climate crisis. All of that should be on the table. The point is, how do we have that discussion? in a way that doesn't make us a global spectacle?
Right.
That's the question.
This has been wonderful. Dalip Singh, my most favorite discussion so far on this debt idiocy. He's with PGIM Fixed Income, of course, his public service to the nation within the Biden administration. Lisa, here is the exact quote from truly an expert on these bond offerings. Robert Schiffman is priceless at Bloomberg Intelligence. Quote, progress towards the net cash neutral goal should benefit further from its planned 5-tranche bond issuance, particularly with proceeds targeted for shareholder returns that likely exceed $100 billion in 2023. That goes exactly to what you were saying.
And this really flies in the face of the narrative that people have been putting out there, which is that the era of borrowing money in the bond market to buy back shares was over because the relative value proposition didn't look as good. Well, for Apple, evidently it does. And basically, they've got nothing else to do with their money except for buy back their shares, which will only make their shares more valuable, given that there'll be fewer of them. It just really raises a question, Tom. Is there really just a tale of two halves here? The companies that can do this and those that can't get capital, that can't get financing, that are struggling in some sort of credit crunch, and it causes that, dichotomy even to grow greater.
I would suggest it's always been the case. I just am not going to believe that there was a We Are the World, everybody got bond deals done in any decade in the last 100 years or so, even 200 years. But I will say the concentration here of superiority, Michael Mauboussin way out front on this at Credit Suisse a million years ago. It's the concentration of these tech companies and other big companies as well. John's favorite LVMH, it's same thing.
But does it get even easier and easier for them to dominate at an era where it's even that much more difficult for the have-nots to gain financing? In 2013, 2014, 2015, companies were getting financing that people were thinking to themselves, how is this possible?
It's a $5 billion tranche, right? The 5-tranche deal is $1 billion each. Boom, 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 boom. I got $110 billion short-term debt, long-term debt for Apple. So it's, for Monday morning TV and radio, it's 5% they're going to add on.
Right, but it's not nothing compared to the debt loads of most companies, and this really is just because they can and they will, and there is plenty of demand, as we've been hearing about.
Did you get a phone call yet? Maybe that's why Ferro left.
to go answer the syndicate desk of Barclays. Yeah, something
John,
like that.
how much would you like?
They've got plenty of demand.
I can see. There it is. We'll keep you abreast of this. It's an important story. We make jokes of it, but truly historic to see this corporation come out with another deal. Adam Tooze coming up. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Joe Biden and Kevin McCarthy have arrived at a crucial moment in their debt ceiling fight. The president hosts the House Speaker and other congressional leaders at the White House on Tuesday. McCarthy wants spending cuts as a condition of raising the debt limit. The president wants to separate the issues. A default would rock the markets, and the White House says it could cost millions of jobs. A new poll shows President Biden's approval rating hitting a career low. It also shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44-38. Russia reportedly has at least 300,000 troops inside Ukraine. That's according to Ukraine's defense minister, who told the Washington Post that his country's pending counteroffensive is being overestimated. And one reason, he said, is the large Russian troop numbers. First quarter earnings plunged 26% at KKR. A deal-making drought continued to weigh on the alternative asset manager. Meanwhile, assets under management grew 6% to $510 billion. KKR's traditional private equity portfolio fell 9% over the past 12 months as a firm marked down the value of investments. An amusement park operator, Six Flags, reported first quarter revenue that beat estimates. Attendance was 1.6 million. That was down almost 6% from the previous year, but still better than expected. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
the truth of the matter is that if those banks, the regional banks and mid-sized banks and community banks are not financing local real estate, commercial real estate transactions, they won't get financed. The role of these banks in the U.S. economy is so high that people actually, frankly, underestimate what these banks mean for our financial ecosystem.
Yelena McWilliams, former chair of the FDIC, and again, I can't say enough about how she has experienced what so many are going through. She was wiped out, her father was wiped out, rather, in Yugoslavia during one banking crisis. She wandered over to America, excelled at Berkeley, and has moved ever higher in the legal business, and of course, her tenure at the FDIC as well. This is a joy, and we had a huge response when Professor Tooze joined us a few weeks ago. He is a Columbia University history professor, but far more than that, was a Barton Biggs professor at Yale University and had to replace the giant Paul Kennedy. Very quickly, Adam, what was it like trying to replace Paul Kennedy at Yale? I can't imagine.
It was definitely a lesson in humility, to be absolutely honest. I mean, Paul is still going strong, it should be said, because when I left, he came back, and he's absolutely
Wonderful.
firing on all cylinders. But yeah, a legend in his own lifetime.
Adam, your essay in March is my early choice for Essay of the Year in the Financial Times. You beautifully walk through the $1 trillion rebalancing as we move from pandemic to polycrisis. What is this polycrisis we're living, and when does the joy end? When do we rebalance to some form of stability?
I think the absolutely first lesson, Tom, is that we probably don't. I think we actually have to abandon that assumption that the best way to think about the world is as a self-equilibrating system that will move back to normality. If you just look at the narrow space of finance, does that seem like a reasonable description of the world that we've been in since the 2008 crisis, or if you're talking about Japan, since the late 1990s? It doesn't seem to me to be that kind of reality. And that's a little bit, I think, what we're seeing in the banking, this mini crisis that's unfolding in the banking system, where ultimately the big driver of that is the interest rate shock, right? And the interest rate shock comes from where? Well, it comes from this unprecedented surge of inflation, which is quite unlike any inflation we've seen before, and follows immediately out of the COVID shock, which ditto is also quite unlike anything we've seen before. So I think we're in this very broken play, a world of a series of not just serious, but quite unique and rather unprecedented disruptions.
Well, and Adam, you say that one of the responses to it has been basically bailouts and the sort of moral hazard of not allowing failure, which you've seen in some of the banking institutions in a prior life would have been considered too big to fail or systemic or any of these natures. So what does that do in terms of the zombies? I know that Tom's been talking a lot about the zombie roll-ups. Do you think that we end up with a host of zombies or zombie assets that kind of are allowed to persist in a sort of inefficient manner for a longer period of time?
I think we clearly need new forms of discipline. We need new forms of workout. And if you look in the legal space, if you actually look in the mechanics of bankruptcy restructuring in the United States, and indeed across the world, lawyers and corporate financial officers are very actively engaged in that process of trying to figure out new forms of discipline, which aren't simply the old-style Darwinian process of free-fall bankruptcy, which is increasingly the exception. Right? There are forms of discipline which don't have to consist in systemically dangerous bank failure, which is the sort of type that we have been at risk of. But certainly, Lisa, you're right, we need to be thinking very hard about how we adjust and how we find new forms of, yes, discipline selection, if you like, in Darwinian terms, to avoid a process of ever greater zombification.
Well, this weekend, when I was reading about the regional banks and sort of where we are and the amount of lending that they account for and the amount of real estate, commercial real estate in particular, that they lend to, I wondered, is this model being challenged? Is the private sector, private equity, private debt, some of these private financing companies taking over a greater share of the business that regional banks used to do and really render them less necessary?
I think it's actually, I would say, rather the reverse, a very healthy reminder just of the actual structure of American society and American business, which, as Matt Williams was saying, is firmly and solidly rooted not in the very large businesses, but in a deep undergrowth of small and medium-sized enterprise. That's where a huge part of the job creation goes on. And the bank ecosystem that the United States has is internationally unusual. Right. America has a lot of banks. But what I do think we need to be taking care of is exactly as you say, the huge shifts which are going on. And in terms of risk going forward, in a way, I'm more worried about that new private equity zone of very untransparent finance, trillions of dollars worth of it in, say, the leveraged loan market, than I am about the FDIC-regulated small and medium-sized banks, which on the whole, when they're not terribly managed, like Silicon Valley Bank was or First Republic, are a crucial part of the American economy.
Adam, you straddle both sides of this with your academics. The book, folks, is Shut Down, How COVID Shook the World's Economy. Adam Tooze can't say enough about this effort from, I'm going to call it 18 months ago. And Adam, I want you to address the polarities in our politics with the too small to succeed. I'm absolutely fascinated by the focus of an America that is succeeding, like Apple with an effortless 5-tranche bond offering this morning. That's all, Bloomberg surveillance babble. There's a huge body of America that feels they're too small to succeed. Where are they in a number of years?
This, I think, has got to be the big worry. I think we're seeing the bifurcation or maybe even a three-way separation of the US economy right now. There are big slices of it which are continuing to thrive. Think of the innovative energy space, the CHIPS Act, the kind of money that's pouring into a genuine revival in manufacturing investment. But those are big players. And what I think we have to worry about is the credit crunch, which looks as though it's beginning to unfold. If you look at bankruptcies amongst smaller businesses, those numbers are beginning to spike. That will, as it were, make that divide, dig that ditch ever, ever deeper. And that's ultimately, I think, what is then reflected, as it should be, in democratic politics, which ultimately, in distorted ways, for sure, but nevertheless does reflect the broad tidal shifts in American society. And at this moment, we are, I think, beginning to see the point at which the extraordinary labor market story, which is, after all, a huge success of the recovery from COVID, America's never seen unemployment numbers like this, could be tipping into something rather different, which would be a sort of two-speed recession or two types of landing. We've talked a lot about hard landings and soft landings and no landings. What if one bit of the plane lands quite hard and the other bit, as it were, soars away?
Well, just quickly then, you mentioned that you are concerned that there's an increasing role of private capital away from some of these smaller banks that is playing a part in what you see as sort of this bifurcation that's developing. Can you explain, can you elaborate on that?
Well, that, I think, would be a third element. This is where the story gets really complicated, because I think the credit squeeze is going to run through the stressed balance sheets of smaller banks. The bit which I think is riskiest, in a sense, not risky the way that a Citigroup getting into trouble in 2008 or a Lehman in 2008 is risky, but nevertheless high risk, is precisely the space in between, the high yield segment. These are big players in that segment. We're not talking about small businesses here, but they are very untransparently linked at this point. And it's not by accident that in bankruptcy in the United States today, the private equity-owned firms are absolutely dominating the corporate, if you like, restructuring and crisis market. That's where this sort of capital goes to play. The returns are outsized if you can get in, and the privileged elite that can play in this market earns those returns. The question we're going to face now is what happens when the risks come home to roost, and where the safety nets are, and whether they're even appropriate to have safety nets for this kind of actor.
And the new financialization as we move into the decade. Adam Tooze, thank you so much with Columbia University. And earlier, you addressed this earlier, Lisa, this idea of the players with money up to their eyeballs looking to do something. And that's when I say financialization, what we're talking about. And there's a body of America that says, hey, what's in it for me? What's in it for us? And the answer is, well, we're going to form jobs.
Well, to me, the idea that LVMH and Hermes came out with these incredible earnings, incredible profits, and then Tyson Foods, a chicken producer, came out and downgraded its expectation for the year because consumers were downgrading to less expensive options, highlights this bifurcation in realities from people with plenty of money for discretionary spending and those without.
Yeah, I think it's a more complicated nuance there in terms of luxury goods and maybe the reopening of Asia versus Tyson and the very complicated dynamics at Whole Foods of shifting from beef where you go, really? to the other stuff, really? And then you get to chicken and everybody's lined up at the frozen chicken things, buying their Bell and Evans and the rest of the overpriced stuff. What an extraordinary Monday. I believe we're going to do this again. In the meantime, William Gross, PIMCO co-founder, stamp collector, in the 1 o'clock hour. Good morning on radio, on television.